Welcome to the BCI Investment Forum for today, 22nd of February. Really good to see everybody else here in person. Unlike speaking to a camera and a screen and never knowing who you're actually speaking to. So really great to see you. We've come a long way since I think the last live-only session we had was in February 2020. And then we went virtual and then hybrid sessions, and now we've got all back to live-only events again. Before we get the proceedings going, maybe just a couple of house rules. Make sure that I think most of you have scanned in already the QR code, so make sure to scan out as well if you leave today, so that you're registered for CPD points. If you haven't scanned in yet, the QR code, we can maybe just put it up there. It is, you can scan in now as well. So please make sure to do that. We are recording this session, so we will share the recordings and presentations with all. We're going to post it up on the BCI website under the Boutiques on Wednesdays tab, so you'll be able to find everything there. But we will communicate when everything is posted up. Unlike webinars that you normally have, just a quick reminder, we can actually hear your cell phones today. So please check that they're on silent, but luckily no dogs and no cats screaming in the background. Always better. Keep an eye out for the BCI marketing mailbox over the next couple of weeks. We'll be announcing the launch of a new BCI partner website. That's for all our managers and most of the managers that you're going to see here today as well. So we're creating a single portal or platform where you'll be able to find any and all information on BCI partners, their content, fact sheets, commentary, quarterly documents, podcasts, or whatever they upload there. So one portal for all the managers and all the info that you'll be able to find. From Robert Walton, Tanya, Olga, and Marguerite, and the BCI team, again, thank you for your continued support. Without you, we obviously won't be here today. From when BCI was launched in 2014 till the end of December 2022, we've showed significant growth with 275 billion assets under administration, and again, it's due to the fantastic work being done by our partners, our managers, of whom you'll see a lot of today, and obviously your support as well. We encourage you to ask questions today, so you won't be able to type questions, right? If you do have a question after each session, we're going to allow for 5 minutes for a Q&A. There are a couple of roaming mics around in the room. Just raise your hand. We'll try to get a mic to you. Or if you feel comfortable to speak loud enough, just ask away. But we'll try to cover as many of those questions as possible. Some thought-provoking matters on stuff that you might have questions on, and not what I was presenting on today. Rest assured that our presenters today and our fund managers today did a hell of a lot of preparation in trying to find the best possible content for you that's sensible. A lot of talk going around in the market, is the risk of a deep recession increasing or not? And as we learned, the only good thing about high inflation is for bouncy castles and not actually for global macros. This is probably the most anticipated recession that we've ever seen, but when and how or how long or how deep this recession will be, nobody knows. And if you look at views out there from some of the top analysts or research companies globally, to local fund managers, views differ significantly. But then again, is it not about how they generate alpha other than trying to understand a possible recession? Macroeconomic pathways are elusive. And I think we've all learned our lessons in the past not to try and make your bed based on forecasting, because it doesn't really matter a lot. There's been some green shoots over the past 6 weeks, and I think clients felt a lot of relief. But a lot of questions from that at the moment, should I start taking profits or should I re-risk? Some clients might feel that they've lost out with this rally that we had in January, but should I now be more cautious or is the momentum going to remain in the market? All of this, some of the stuff that we'll be covering in our sessions today. Also, think about things like the US dollar. Not that you can predict the rand or the dollar, but the dollar is quite expensive. And it's a time for things like anti-dollar plays, or how does that play out in the different funds managed by our partners? You're going to hear some or a lot of talk about China unlocking and how China is counter-cyclical to your developed markets, and what is the benefit for China other than naval exercises, but what is the benefit for countries like emerging markets or South Africa? And if you get down to South Africa, will it really benefit if you look at our tattered economy and if you can't even get basic things like energy right? So without further ado, we're going to start with our equity panel, and joining me on stage is Richard from Blue Alpha, Evan from 361 Asset Management, and Edo from Methodical. I think you're all very familiar with them. You've seen them how many times on boutiques on Wednesdays. Gentlemen, thank you very much for joining us this morning. We really appreciate it. SA Equity is cheap, and it looks cheap by any kind of matrix that you want to measure it on. But again, the choice is shrinking in SA markets, and a couple of questions on SA Equity. It looks very attractive, but should one increase exposure on that, or where are we going on SA Equity? Richard, thank you very much. You are first for our panelists today, and we look forward to your presentations. Thank you very much.
Right, good morning, everyone. Nice to see some familiar faces here. What's going on? Presentation's starting to drive itself here. Yeah, thanks to BCI, we were given strict instructions to wear plain white shirts, so I hope I've achieved that. Evan has. I think we're all okay there. Eugene has basically done my presentation. He spoke about recession risk and the fact that SA equities are cheap. So I'm going to try and add a little bit more color in 15 minutes. So I'm going to start the clock, or you're giving me extra time because I always go overtime. Anyone? No. Okay, so the three big concerns at the moment are kind of self-evident and obvious to everyone. Global recession on our doorstep, very topical issue and lots of data around that. And I don't have to tell anyone about the Eskom crisis, but I think we'll just dig a little bit into what it really means. And then the fact that the way we look at South Africa, it appears to be a very low growth environment. So starting with the global recession, for anyone who's chipped a tooth, and I chipped a tooth the other day, you know that when something changes in your mouth, all your tongue can do is go to where that tooth is. And that kind of seems to be the story for investors in terms of the global recession, and we just can't get away from thinking about it. And indeed, there's good reason for this. If we look at the yield spread or the yield curve, which is inverted, and we look at the 10-year versus anywhere between the 1 and 3 year, historically this has been an almost foolproof method for predicting global recessions historically over the last 50 years. So that's a very concerning factor. Now, there's a lot of debate about what is driving long-term rates versus the short-term rates. We know the Fed is pushing up short-term rates to try and deal with inflation, and perhaps the long-term rates are being held down by sort of other Fed activities, but nonetheless, this is a stark kind of warning factor for us. And then, of course, if we look at something like, particularly in the US, the leading economic indicators, you can see the graph on the right, the dark blue line has gone negative. And that also has been a precursor to recessions in the past. Now, offsetting this is some very, very strong economic data. We had the latest jobs report. I think it was 3 times what the market was expecting. Not that one should place too much emphasis on sort of forecasts, but nonetheless, it was a huge number. And we also know that unemployment is at roughly 50-year lows. So, and certainly up until last night, the consumers seem to be in pretty good shape. So this is, these forces are kind of, fighting against each other. And we see this playing out in the market, and this is at a very, very kind of micro granular level. And we're just showing the performance of the S&P versus the bond market exactly 2 weeks ago, when Powell was interviewed at the Economic Club in Washington by his friend David Rubenstein. And what was interesting about this, if you took the content of the talk, the content was quite simple. Jobs are strong, inflation is sticky, rates are going to be higher for longer. That was the punchline. But when he started speaking, and you know, there was some sort of commentary whether it was a very informal chat as opposed to prepared remarks that the Fed normally does. So this was an interview style with someone that he knows very well. And the market responded. If you look at that sort of grayed out area on the left-hand side, the market rallied into the interview. And then as he started speaking about the need for higher for longer rates, the market sold off quite dramatically. And if you contrast that with the bond market kind of moved in sync. So yields initially went down, and then they rallied back up again. And then you had this kind of schizophrenic, slightly dichotomous behavior between the bond market and the equity market, where the equity market once again turned around and rallied. Actually had a very, very strong day. I think it finished up 2%. The bond market, measured in terms of yields, did quite the opposite. So it continued to weaken. Yields carried on going higher. So that's the kind of contradiction that's playing out in the market in many senses. Now, I think what's interesting here, we've just shown the S&P 500 as a proxy for the market and the Fed funds rate, and we've gone back to 1980. And the thing that stands out for me about this chart is if you look at the Fed cycle, there's kind of up cycles and down cycles. The long extended cycles have really only been at low levels of interest rates. So, you know, imagining an environment where we have 5% rates, say, there's some argument that 5% is the new neutral rate, will be quite a challenge, I think, for the market psychologically to kind of wrap its head around. Historically, whenever you've had a rate increase cycle, it's kind of been followed by a peak. So in other words, there hasn't been this plateau of rates. So that will be a very, very different environment. And it forces us to think about valuations. You know, what if rates are 5% for an extended period of time in the US? It forces us to think about the cost of funds, companies that have leveraged balance sheets. And of course, it forces us to think about the impact on the consumer. Eventually, this will have quite a serious impact on the consumer. So I think this is something to be concerned about and something to think quite carefully about. We don't know the answer, but we suggest caution would be in order at this stage. In terms of Eskom, I mean, we all see the same data on Eskom, so there's no need for me to delve into it. But I speak to a lot of people, and a lot of the sense seems to be that, well, it's fine. As South Africans, as businesses, we are going to privatize power generation, and we'll be fine in 5 years' time. And I think what we mustn't forget is there have been, and there will be significant costs in the interim, huge costs. So there's the first level of cost, which is, loss of stock, shrinkage, loss of trading hours. Then there's the cost of power generation if you're using generators. And finally, the extra balance sheet cost if you yourself are going to start investing money in power generation. So all of these speak to lower margins, higher costs, and those filter right through the income statement down to earnings. And there we've just listed some of the companies in terms of how it's impacted them. This is all in the public domain. Astral spoke about a 90% drop. Fushini, in terms of how many trading hours they've lost. And it affects everyone across the board, Woolworths, ShopRite, Mr. Price. So going to the story about South Africa, again, many people say South Africa is cheap and therefore a good place to invest. I kind of battle with that logic, but then again, I'm not a die-hard value investor. Here what we're showing is South Africa incorporated, if you will. So we've stripped out rand hedges and miners, and we've shown it going back to 2012, so 10 years. And basically what you can see is the index has done nothing since 2014, and that kind of makes sense if you look at the growth. I think through time, the growth is about 5%. So the light blue line is showing the earnings trend. So a very low growth environment, and certainly over the last 5 years, particularly poor, looking through the sort of COVID drop-off. So with that in mind, how are we thinking about local equity? We are a quality house. Quality is a key component of how we invest. And for us, quality speaks to essentially the return that the assets generate. What kind of return, what kind of cash flow return do the assets generate? And I always say the simplest way to think about this is if you owned a private business, you would very quickly know whether it's a good or bad business based on how much cash it needed. So you would think less about the growth, and you would be highly attuned to the cash that the company generated each year and how that return compared to the cost of capital. So very quickly, I'm going to talk about Woolworths, Shoprite, Richemont, and then a quality switch. Woolworths, quite a simple idea. It's a defensive, high-quality, large part of it, food business, as we know. And here we show in dark blue the cash flow return on invested capital for the group in dark blue through time, and then for the South African business in gold. And clearly, with the benefit of hindsight, one can say that the David Jones acquisition was a complete disaster and a waste of time. And the fact that they are now unwinding this, there's been some recovery in David Jones, but it's coming off balance sheet, informs us that there's going to be a trend back to this higher cash flow return on investment profile for the company. So we think it's a defensive business, and we're quite pleased that they're finally dealing with the David Jones acquisition, which has been value destructive through time. In terms of Shoprite, here we show we're showing again cash flow return on invested capital for Shoprite, and we're comparing it to Pick n Pay. Now, I think in South Africa, if you want to make a very simple story about the consumer, you can sell to the high-end consumer and you can sell to the low-end consumer. I think the kind of middle class is being gouged out a little bit, or has huge pressure, but there certainly is a group of people who are making enormous amount of money, and you can sell Louis Vuitton handbags to them, you can sell them Rolexes, and the Range Rover, Land Rover dealership in Sandton is still doing very, very well. So the high end is doing fine, and obviously the low end is substantial and to some extent also supported by things like government grants. And here what we're showing is basically the efficiencies of the two businesses. So if you look at, it's been a tough operating environment, but nonetheless, through time, Shoprite has managed to hold its cash flow return on invested capital, whereas Pick n Pay has lost in margin. It's lost in working capital efficiencies, so efficiencies going backwards, and you can see through time its returns have fallen. So our preference for Shoprite. Richemont has changed a lot in 14 years. If we go back to the global financial crisis, it had much bigger exposure to watches. 80% of its EBIT is now essentially jewelry. And what's interesting is that jewelry, certainly through the global financial crisis, it didn't suffer the slowdown in sales that the watch business did. So a kind of more defensive profile than what it used to be. Obviously, it's had a great recovery. The valuation has come back quite a lot. It has a very robust balance sheet, about 5 billion euros of cash in the balance sheet. And the operating momentum is kind of on its side. And so another idea that we have been in for a while and are positive on. Now, when we talk about quality, it's quite easy to say, well, this is a rubbish business. Say, good example in South Africa would be Nampak, very poor returns for a long period of time, and we all know what's going on with Nampak at the moment in terms of trying to raise capital. That's invariably what happens to these low-return businesses. But what happens comparing businesses within the quality realm? So for us, Mr. Price is a quality business. It has good returns, as does Truworths. We, in the last while, have switched from Mr. Price to Truworths. And here we try and explain our reasoning for that. So Mr. Price, you can see over the last 4 years, its returns have declined, and the drivers of that have been loss of margin and working capital. Truworths, in contrast, has managed to increase its returns, And the key driver that has been fixed asset efficiency. So effectively, they're running the business more efficiently. And how have they done that? Well, here we show Truworth's total trading area and number of stores on the left, and you can see they've been reducing the trading area. So basically, they've been getting rid of trading density that is subpar. And that's what the graph on the right-hand side shows. It shows merchant sales per store and trading density. So trading density is going up, fixed asset efficiency is going up, returns going up. Now, of course, you can say, well, that's all reflected in the price. And to some extent, that is true. The market does respond to these things. So we're showing Mr. Price on the left, price relative, which is the gold line, and the sort of bronzy line is the earnings relative. So earnings relative to the market has been declining, as is the price. And Truworth's kind of opposite picture, earnings relative outperforming and the price has gone up. So the question is it all in the price? And this kind of gives you insight to how we think about things. Rather than forecasting the future, we say, what does the current market price imply about certain things? And you can sort of backwards solve this. And it's not to say that stock picking is as mathematical as this, but it is iterative in the sense that you can do these exercises to kind of present an answer. So I don't have the time to explain all the detail here, but essentially, if you take the market implied growth for Truworths versus Mr. Price, the current prices imply that Truworths' future growth is -2% and Mr. Price is 8%, and we think that's probably a bit unrealistic. As always, I'm running out of time, so just quickly in terms of our South African equity factor exposure, here we rank the portfolio against the market index, and you can see on a factor basis we are overweight quality, we are overweight momentum, and then the rest we kind of neutral. So one of the challenges we've found in South Africa is there is growth, but a lot of the growth, to get the growth, you have to sacrifice quality. So that's the kind of trade-off. This just shows historically, for us, quality is the right place to be, and this kind of shows long-term returns, risk, and reward. So the returns and the risk of a drawdown over a negative return over a 12-month period. And you can see in the top left quadrant, which is where you want to be, quality growth, high quality, far exceeding the indices. Quality hasn't actually been a particularly good approach in South Africa for the last couple of years. And if you look at the table on the right, you can see our SA equity carve-out, if you will, so pure South African equity versus SWIX. And you can see, we've kind of given up some returns. It worked very well prior to 2019. But for us, another way to look at it is how have we performed versus quality within South Africa. So that's what the graph on the left shows. The blue line is our performance of our local portfolio, and the gold line is the Satrix Quality Index. So, I think that for us is a kind of more important chart in terms of saying how are we delivering on our particular style. So in closing, I think, I don't want to read the graph to you, but essentially, consumer-facing companies have fixed their costs and their balance sheets. They now need revenue, so they need some growth. And a lot of the retailers have posted some encouraging results. We are overweight food retailers and food producers. We're avoiding companies with leverage, high interest rate environment, and also companies that we feel might have to go back to shareholders for capital. We're underweight gold equities. We don't particularly like gold businesses, which is different to gold itself. And then basically just looking for companies who understand operating in a low growth environment. We think that is the most likely outcome in South Africa. And then just a final point in terms of labor. Costs, we think that labor costs are going to increase, so we're quite sensitive to which companies are exposed on that front. My last slide, just because I haven't given a very upbeat presentation, this was just something that I saw, which I'll throw out there. It was an analysis which showed the years in which the S&P did 5% or more in January, and the previous year had to be negative. And then we show the full year returns are shown in the column on the right. And I'm not sure that this is analysis or what it is, it's just numbers, but I'll throw it out as a potential positive. But I will say this, my final comment. The Fed tends to break things. Almost always, if you look historically, it raises rates until something breaks. I don't know what will break this time, but that's something to think about. Thank you. I've gone over my time.
Morning, everyone. Great turnout. Anything for electricity these days? We'll kick off with the performance, because probably that's the best part, and we'll slide downwards from there on out. So yeah, we've managed to outperform the market. It's been a good run, and we're certainly going to hope to stick with that performance, and we've certainly had a very good start to the year, specifically in our equity fund, where we've got big offshore exposure, but likewise, significant outperformance in our SA equity fund as well, start of the year. Hedge funds, guys, I won't start on that because obviously BCI will fire me if I talk about hedge funds at this conference, but we do offer them, so please chat to our ladies and they can address those issues with you. Slightly different presentation to Richard, which is nice. I think we're going to take a step back for 30 seconds or so, just see where the world has come from, where we think it's going to, what the big issues out there. We all know them, but just let's readdress them. We had a mammoth run in the US of consumption, mammoth. Companies in the US experienced double-digit volume growth, high inflation, big tailwinds, guys, big tailwinds to consumption. Lovely from an earnings perspective when you're running, okay, with that behind your back, and that has begun to turn. On the other side of the pond, China, obviously a different equation, lackluster consumption. The big question is now, how fast will China come back? Will that differential meet? How reliant is China on, okay, global spend, specifically US spend, and obviously a downturn in that, and how vigorous will that Chinese economy be into this part of this year? A big positive for markets, which you saw this rebound, was obviously gas prices coming off significantly in Europe. Post the war, it's now down below pre-war gas prices. Very strong, well, very warm winter in Europe. I mean, that's the only positive about global warming, is that the Europeans haven't frozen to death and haven't used all their gas storage. Gas storage is at 60%, it's normally at 20% this time of the year. So this has been a big positive from an inflationary perspective and a consumption perspective, and obviously the markets have liked that in conjunction with the China reopening. This is also important though, strategically. For me, running quite a bit of oil in the funds, and specifically in the offshore funds, what do I think Putin's going to do here? He couldn't strangle the world without gas, okay? The Germans were a little bit cleverer than him. They got sorted quickly. I think he's going to start strangling the oil with the world with oil. So he's cut 500,000 barrels effective this month, okay, going into the month end. I think he's going to continue to cut. Okay, it's the only damage he can really do to the world now, okay, given that gas prices have fallen. So we're very positive still, specifically in our global funds on the outlook for oil. And the companies are cheap. Unfortunately, in South Africa, we have to sit with a pig with no legs called Sasol. What am I looking at here? This is just a change in interest rates. It's been the biggest delta ever, okay, in rate changes across the world. 0 to 5% in the US. Bonds have gone from 2 to 7. A friend in the UK the other day said to me, Evan, when I got here, I was paying 2,700 Rand a month on my mortgage in the UK. It's now £4,800 a month, okay, mortgage on his UK. So 2,100 up, okay, in a 3-year period. Guys, this is still going to hit consumption hard. Okay, we just think the market is still a little bit too sanguine, okay, on these rate increases and potential shifts in consumption, given that most of these mortgages are 2 to 3 year fixed, and they start rolling off quite soon, and they roll off into next year, and rates won't be sufficiently down by that period, okay, in order to sufficiently counteract it. The big thing for us has been this tailwind of consumption around the world, and we're now moving into a period where consumption and revenues are coming down, but costs are still high. And we still think the global markets around the world haven't really bitten into this margin squeeze that we still think is coming. We still think there's this big margin squeeze that's coming. We're still very cautious on the outlook for equities. in most of our funds, in our flexible funds, even in our equity funds, and in our SA equity funds, we're even trying to protect capital as much as we can. But we're still nervous the outlook for this year. Okay, we've got this big tailwind that needs to settle. We've still got a rising cost environment, and that's never that good, okay, for equity markets over a 1 to 2 year period. US demand is slowing, which is good. It needs to slow. Obviously, we've had this rampant inflation, which everyone's spoken about. It needs to slow. Contraction is coming back, which is good, okay, in a way. You don't want to come back too far, otherwise we've got a recession, which Richard spoke about, but it is coming down, okay? The negative is that China is very reliant on it. So you've got this double-edged sword that you've got an opening economy, which is still reliant on exports, okay, to the rest of the world, which is slowing quite fast. So it's not an easy equation when guys go, gee, China's reopening, jump in, fill your boots. You've got to think a little bit further than that. As I spoke about, CPI coming down, which is good, it's coming in. But again, as Richard spoke about, labour market, wow, the labour market's pumping. Guys, it's absolutely pumping. And it's something that we just can't get our heads around. I've just come back from New Zealand, 6 weeks, saw my daughter in New Zealand, Australia, my son in Australia. They just haven't got people. My uncle's 75 years old in New Zealand. He's just gone back they asked him to go back and drive a school bus. They can't find a school bus driver. They're paying him 32,000 Rand a month to drive a school bus, 2.5 hours a day. They can't find anyone to work there. There are no people, okay? If you haven't got a job in South Africa, or children haven't got a job in South Africa, tell them to go and work in Australia, New Zealand, okay? They get paid, okay, 320 Rand an hour minimum wage. It's not so bad, okay? It's not so bad. But guys, developed markets just haven't got people. We haven't worked out why, okay, so many people have exited the labor forces, whether it's in Europe, whether it's in Australia, whether it's in New Zealand, whether it's in the US. We just haven't worked out why there's such a shortage of labor, okay? But obviously labor coming back in the US has been quite strong. People are coming back to the labor force, and there's still been a huge hiring boom, which we've seen, as Richard mentioned in the latest stats, up 577,000 jobs in January off an estimate of 100, and what was it, Richard, 180, I think, at the onset, which was crazy, the numbers. But that's the starting point now. You sort of almost got to break them. The Fed's almost got to break, okay, this labor market, get it down and get it in control. We've seen the front end now, the Microsofts of the world, etc., the Amazons start retrenching, but it's still got a long way to go. So that's the problem, is we're probably going to be a little bit higher rates for a bit longer, and that's the world that we're going to be living in for a while. Guys, let's jump to the other side of the equation, China, the two big economies. Housing starts in China continue to fall. They're not going up. Land sales are down 70. The front end is still looking quite weak. A little bit of impetus now coming through on the municipality side, but very, very weak in China. So the restart, there's been this massive restart. Resource stocks have flown on this reopening cycle, but the front end is still looking very weak, where confidence is still quite low, and probably rightly so, given that they've been in this lockdown environment for so long. A little bit of momentum coming through on the infrastructure side. So government trying to push quite hard on the infrastructure side, but we need property to come back quite strongly, and that's the big unknown here. There's such a saturated property market in China. There's obviously been this huge fallout of the property sectors in Hong Kong. Last year, the defaults alone on the property stocks were $85–90 billion in unpaid bonds, $4 trillion of outstanding US dollar debt, $1.5 trillion write-offs from banks in China. It's been messy, guys. So this is the big unknown, and this is the big unknown for obviously our resource counters, our BHP Billiton's Anglo sector, because 25% of world iron ore goes into China property. It's actually 2.5% of global GDP. It's so big. It's a mammoth number, just absolutely huge in the context of world growth. And that's still very lackluster and very little sign of turning. We watched the credit impulse in China. So credit impulse has bounced back, but total social financing, actually money distributed to the economy, is still falling. So the impulse, i.e. rates are coming down, liquidity levels are obviously being enhanced in China, but people are just not borrowing to the extent that they did. And the borrowing levels are so high that even if you look at the context of January now, it was record borrowings, okay, on a month-on-month basis, but it's still only the same level as last year because the numbers are so big. And as we know in the investment game, Okay, you need growth. Okay, you need a delta. You need a marginal buyer for everything. So it's either got to be price or marginal buying. People have to buy more. Okay, they can't buy less. So this is still looking a little bit messy. Hopefully it turns a little bit more sharper post, obviously, the Chinese New Year. Hopefully that comes back a little bit, but still the jury's a little bit out for us on that, and these stocks have run hard. These resource stocks have run very hard in the transition. A sector that we've sold down aggressively over the last couple of months has been platinum. This is just the EV transition. Wow, guys, it's come way faster than I thought. Way, way, way faster. China alone last year sold 2 million more vehicles, okay, EV vehicles than they did the year before. It went from 3 to 5 million EV vehicles last year in China. Okay, it was huge. Okay, prices are falling. There's a price war in EV. Okay, Tesla's reduced prices now. Post the subsidies been reduced. Okay, but these things are still flying off the shelves. Okay, we don't really see a future for platinum. It's a big problem for South Africa. Terms of trade on platinum, it's very important for South African fiscus. Okay, I can't overemphasize that. So we're quite nervous the outlook for the rand now, given load shedding, obviously additional diesel costs, as Richard spoke about, being paid, likes of Shoprite spending R1 billion a year. Guys, that's going to come out of the fiscus. But a big problem for us is actually these terms of trade, because you've got a weakening iron ore market, and we've now got a significantly weaker underlying fundamental, okay, for the South African market in platinum. And I can't see this coming back. Okay, you know, this is really going to escalate now out of proportion. The guys are talking China now going from 5 million EVs this year to 7, okay, and potentially 9 by the end of next year. Okay, that'll be, you know, we can see the numbers already there on the China side. I mean, they're already up to, they're going to be close to 25, 30, going to be close to 30%, nearly 40% of their total consumption. China is the biggest market in the world, 22.5 million, 23 million vehicles. Okay, we're going to have 30, nearly 40% of those vehicles, okay. The delta on that alone, okay, is nearly 20% of total vehicle consumptions in the world. It's going to kill these poor platinum guys, kill them, and their costs are rising exponentially. We've just seen the results. Sabanya's share price was down yesterday, I think 9-10% at one stage, came back a little bit. But I mean, the future of this, but more so from a big picture perspective, is the terms of trade and the reliance on tax revenues, okay, and exports out of South Africa on the platinum side. So that's a little bit concerning for me, looking at 12, 24 months from a rand perspective, looking forward. Guys, we know about load shedding. It's got worse and worse. We were promised 2 to 4 2 weeks ago by the rate, and we're back at 6s and stuff. And now we've looked at every forecast. Like Richard, we've looked at every forecast, spoken to every expert, try to estimate what we think is going to come online next year, the year after, 9,000 megawatts, 6,000 megawatts. Everyone's got a different forecast. One thing we do know, it's going to take longer. Okay, it's going to take longer. The mines will eventually get there. They'll put in a lot. Okay, they will put in a lot. We know Anglo-Americans are going to spend 500 billion. There's going to be a lot coming. So out of every bad, there is a good. There is a good. The banks are going to finance more. There'll be domestic work on the ground. But for the poor mom and pops, and even for the guys that are having to spend on diesel, and I've got a lot of friends running diesel generators now 6 to 8 hours a day in businesses, and it's costing them a fortune. It's hurting the domestic economy, as we know. Guys, and we know, we've all seen this now in the news, it's hurting food prices. The farmers are getting killed with this. I didn't realize at the onset that agriculture took so much electricity, you know, so much to milk the cows and irrigate your lands and stuff like that. You know, I've been a useless accountant. I mean, what do I know about farming? You know, but only when you start to read and listen and you speak to the likes of Astral Foods. I know Chris Skitter well. I've known him for 20 years as CEO of Astral. I mean, these businesses are under a lot of pressure now, okay, from a cost perspective, from a distribution perspective, and that's going to feed its way into food prices. And believe me, Peter Engelbrecht, the CEO of Shoprite, is not going to sit there, okay, and absorb R1 billion of the diesel cost. It's coming to the consumer, and it's coming fast. Okay, we're going to pay for this in the cost of our food, the R1 billion. Ultimately, he's not going to absorb that in his gross margin. Okay, he's not messing around and waiting for his share options to go down 30-40%. Guys, a summary of local views. It's going to be tough. It's costly to South African business. My big concern is obviously the fiscus now. It's obviously the fiscus. You haven't even heard people speak about this, but it's coming fast for the platinum guys. Okay, it's coming fast in costs. We saw huge downgrades to earnings now. 30, 40, 50% from the platinum guys that have just reported. It's coming through hard on the fiscus. As I said, out of every bad scenario, there's a good scenario, okay? Guys are running hard now to put in solar, renewables, and we are moving quickly. So we still like the banking sector. They're going to loan a lot of money here. Okay, they're going to loan a lot of money to corporates. There's a lot of JVs being set up. There's going to be trillions pumped into this, okay, because they have to. Okay, and they have to. And big companies have done it already. Ford is self-sufficient. If you look at Ford's facility in Pretoria, I've been there. It's unbelievable, guys. They don't need a single bit of diesel. They don't need a single bit of anything from Eskom. They can put back into the grid, funny enough, as soon as we get our distribution right here, which is a problem. We need 200 billion to sort that out. But I mean, these corporates are going to make a plan. It's going to take time, okay? But it's going to also be on the other side of the equation. They are going to be beneficiaries. We own some Roynet in the portfolios. We own companies like Udeco, etc., that are beneficiaries of this re-energization. So we've tried to pick up some of those trends. It's not all bad, okay? It's not all bad. I won't bore you with the rest. I am worried a little bit about inflation. It does worry me a bit on the food and the bottom end of the market. I think tourism's actually going to be fine with the rand. I mean, Cape Town's pumping. I mean, you can barely get into the waterfront. It's so power at the moment. I think we'll actually be a reasonable beneficiary of this weaker rand. So it's not all bad, guys. It's not all bad. But the big underlying concern to me is just this terms of trade, okay, and the worry about the fiscus into next year, okay, on this declining market. Sorry, I'm taking up too much time. China, what are our concerns? Very quick pivot, market overreaction, we think. We've cut a lot of resources in our portfolios into this run-up. We've cut as much platinum as we could. It's fallen away quite fast. We've got a smidget of platinum left in the portfolios, but we've decimated as much as that, and that's been good for us. We've held on to our gains. The US has been supported well, strong market, but now we're seeing quite a big depletion of savings. That does worry me from a China perspective, a growth perspective, just if it actually fuels that growth. And then obviously the Fed pivots, the big question on everyone's mind there. It's going to come, guys, but it's going to come a little bit later than we thought. But we're going to be positioned for that. How does SA benefit from that? I think as we start to see a pivot into that, I don't think we benefit as much, but we'll get a bit of a spin-off. Maybe the US dollar, not as strong, starts to come down a little bit. The rand does. If we start to improve, I'm talking sort of more 18 months, 24 months out now. We've got to be positioned for slightly better electricity, more self-sufficiency. We've got a little bit of the next year is going to be tough from an SA perspective. Let's not fool around from an equity perspective. But this is also a good time to ensure that you lock in capital gains in the portfolios, you be a bit more conservative in the portfolios, and ensure that you actually protect people's capital. Guys, that's just relative attribution. I've run out of time. I'm not going to bore you. Those are good numbers, so we'll show those for a bit longer on the performance side. Okay, just stare at those. Okay, lock those in. Make sure you know who you're looking at when you tick the box there for your clients. Guys, quickly, we run out of time, so apologies. That's just our shares. Just to bear in the back of my mind, we're still running a sort of 60-40 split. 60, what we would define as rand hedges, dollar earnings, lots of Richmond, like Richard. We've actually got more than that now. This was the end of January. Close to 4% there. We've cut our exposure in resources. We've cut Glencore back. We've even cut the Impalas back in the last couple of days. We've got this 60-40. We haven't written South Africa off. We haven't written it off yet. We don't think it's a failed state. We're trying to pick up opportunity where we can. There's still quite a lot of dollar earnings in the South African businesses, the Grindrods, etc., which export out of Mozambique. We think are big beneficiaries. We've bought businesses that have been, what we think have been overly destroyed, like the likes of Spar. We've added a lot of Spars. It was a 200 rand business, come back to 120. We think there's a lot of operational leverage in the Spar business. We've been buying there. So guys, we've been opportunistic. We've been looking for ideas. We've tried to stay away from highly leveraged businesses. We try to run a conservative overall portfolio with the likes of British American Tobaccos, a lot of Bidcorp, a lot of international earnings in that portfolio. Just try to stabilize it, but at the same time, still looking for opportunities. We've done very well buying businesses like Supergroup, down to 26 Rand, 32 Rand yesterday. It's done nicely for us. There are still businesses doing very well in South Africa despite all the mayhem. Distribution bad, buy Supergroup. Okay, power bad, buy more Roynets, buy more Udacos, buy more other businesses, buy more banks that are going to benefit. So try to look for the positives in the negatives all the time to build on, okay, what's been a great performance. Thank you, everyone. Appreciate your time.
Morning, everyone. Thanks for your time. Great to be here. For the guys who haven't met us or Methodical with regards to this BCI equity fund, if you have to, I guess, label or box our process or style of investing, you can put us squarely in the momentum box. To delve just a little bit deeper of what is momentum investing and how we combine it within our process. So you essentially get two different types of momentum investing. The first one being a time series momentum, which is where analysis is done on the momentum of a specific share, instrument, or asset class relative only to itself. And you actually buy or sell that share. If it's trending upwards, you're buying it. If it's trending downwards, you're selling or shorting it. Now compare that with relative momentum. It's where you actually look at the relative momentum of a share, instrument, or asset class to other shares, instrument, or asset classes. So again, if there's positive momentum, you buy the whole bunch of positive momentum and you sell or short the ones with negative momentum. So within this equity fund, we actually combine both types of momentum investing, but keep in mind, this is a long-only fund, so there's no shorting in the fund. So if you look at the middle slide, sorry, the middle picture of the slide, this is essentially what we're trying to do. Trying to start buying or investing in a share once the bad news is actually removed from the share or from the company and is starting to trend upwards. And then selling that share as soon as we possibly can when it starts showing negative momentum. So compare that with a, I guess, traditional fundamental way of investing where, I guess guys will actually calculate what's the intrinsic value of a company. They'll calculate what they think is a margin of safety. And if that share is trading below the intrinsic value, they'll start buying. If the share price is trending downwards, they'll hopefully buy more and essentially hoping it's not a value trap. We basically do the exact opposite. We'll start investing in that share only when it starts trending upwards, and we won't sell that at any point if it's still showing upwards momentum. The question is why are we momentum disciples? And for me personally, it's quite simple because it works. It's worked over all time periods, and this is not a back-tested track record. This is an ETF that you can invest in today. The red line is the MSCI US Momentum ETF. It's managed by BlackRock or iShares, and it outperforms the S&P 500, quite significantly. The S&P 500 is arguably the most difficult index to actually outperform from an active manager point of view because it's the biggest. It's got the most market participants. The interesting thing is that even though everyone knows basically how momentum investing works, and there's a lot of papers published on it, the alpha has never decayed since the first publication in the 1990s. In fact, it's actually been increasing. And BlackRock has gone so far to actually show you exactly what they do. They literally give you the secret sauce of how to outperform the S&P 500. The next question is, great, it's worked, but will it actually work in the future? So, I think this is quite topical. Hopefully everyone would have heard of OpenAI, ChatGPT. We don't incorporate artificial intelligence into our process, but this is, we think, the next big trend that's going to happen in the global space. And momentum investing will continue to outperform and continue to deliver results because innovation and the discovery of new technology will not fade away. And it's innovation and the discovery of new technology that leads to new trends, new companies, new industry, and new opportunities, and ultimately new investment opportunities and business cycles. And if you think of the way that technology behaves, it increases exponentially. So this trend of new innovation and technology is actually not only going to stay here, it's going to increase in speed. And a few examples, simple examples, is just think of the revolution of what's happened the first time when the wheel was invented. What is spawned just from that invention? More recently, another simple example, just the internet in the 1990s. How has that impacted our lives in the past 25 years? So when it comes to AI, we can't tell you how this is going to impact our lives. in the next decade or two decades. But we can tell you with absolute certainty is that momentum investing, or the factor momentum, is the factor that keeps on searching for those trends, and it will jump on that trend and invest in that trend once it arrives. Finding the right trend is perhaps one thing, but actually making money off it is the tough thing. I guess getting to the next slide is probably tougher. Guys, was the slide working? IT guys, anyone?
It's the AI.
I know. Well, we can go backwards, but we can't go forward. There we go. So finding the right trend is one thing, but actually making money off it is the challenge. And in this case, if you look at the red line, this is I think the stuff dreams are made of. This is the track record of Peter Lynch. He used to manage a fund called the Fidelity Magellan Fund. He managed this fund since 1997 all the way to 1990, and then he retired at the ripe old age of 46. He actually annualized 29.2%, which is double the S&P over that period. But Fidelity has actually provided the details that the majority of investors in this fund actually lost money, which is significant because, I mean, that's a clear trend, bottom left, top right. But the challenge for investors is that they invest with their emotions and with their gut. They treat drawdowns as a cancer as opposed to the normal kind of ebb and flow of trading and investing. So the key for us in managing this fund is quite simply to switch off all the emotions and just invest with our brains. So we follow a pure systematic approach, rules-based approach. We don't read financial statements. We don't do any forecasts or predictions whatsoever. And essentially, this is what you get from this fund. So as I've mentioned, it's rules-based or systematic. So we collect millions and millions of data points from the market. We run a series of calculations, algorithms, if you will, and that delivers a portfolio which is currently sitting at 30% offshore exposure, 70% local. So myself and my colleague Charles Kidd, we don't see ourselves as portfolio managers, we see ourselves as risk managers. And if we take care of the inputs and we take care of the process, the output will take care of itself. And on the right-hand side of that slide, that's the output so far. So the fund is approaching a 7-year track record in June this year. We've never once overruled the process. And it's been a consistent outperformer of our benchmark throughout this period. So it's a different process, it's a different output, and that leads to very, I think, in my view, attractive correlation numbers. Because, this is our correlation numbers over time relative to the largest equity funds in the country, equity funds with offshore exposure, which we have as well, so it makes it a bit more fair. And you can clearly see that our correlation numbers are the most attractive or the best or the lowest relative not only to the peer group, but also to the all share. And our highest correlation number is actually our peer group's lowest in this comparison. So essentially, as you guys well know, if you combine portfolios with low correlation, you actually decrease the volatility of your fund, which hopefully gives you a smoother outcome. So hopefully we can spend some time here, learning from Evan. So let's look at the performance. This is the rolling 3-year number of our fund. So for the past, the fund started in June 2016, approaching 7-year track record June 2023, and basically 95% of the time on a rolling period, we actually outperform the equity peer group. And this is for me, the crux of momentum investing, because the factor momentum actually changes its style over time. So whether growth is doing well, momentum will move towards growth. If quality is doing well, momentum will move towards quality. Because if you're let's say, a pure value manager and your style is out of favor, then you actually can't outperform. But if you're a momentum investor, once a style comes in favor, you change your leopard changes your spots. So just summing this up, there's consistent performance across the patch. The correlation numbers look good. There's outperformance. And look, I've got a lot of time left, actually, so I went through a bit quicker than I thought, but we actually just finalizing on any of the presentation here. This is our current positioning. Don't ask me on why we have Naspers, what do we think of Freshmont, or what do we think of Woolworths. You can ask those tough questions for these guys. So to end off, if there's any questions on our portfolio or our process, happy to answer them. That's it.
Many thanks, Richard, Evan, and Edo. Any questions for the gents on stage? Don't be scared. You can't type. You need to put up your hand. Right. Right, so we're going to move on swiftly. So, gentlemen, thank you very much. No questions from the audience, so thank you. Are you going to stay for lunch? Can they chat to you during lunch or tea time? Thank you very much for that. And I do think, maybe just to wrap up on that, you know, we've seen how you can't be out of SA equity markets. There are definitely some good opportunities still out there. And I think Edo's presentation also very interesting. If you do looking for, or if you are looking for a momentum type fund that are decently priced, there's very few out of them in the SA market. You can look at Methodical. So thank you, Richard, Blue Alpha, 361 Asset Management, and Edo, thank you for presentations. Cool. Right, our next session on local bonds. There's been a lot of talk on local bonds, very attractive yields at the moment, and a lot of clients thinking of increasing bond exposure. How to do that in portfolios can be very interesting. But if you look at 2022, although bond yields have been very high, it came with a hell of a lot of volatility. So the question then is, what can one expect for 2023? You will reset the clock, don't worry about that. You still have your 50 minutes. Joining me on stage at the moment is Rowan Williams-Short from Vunani Fund Managers and Ruan Naidu from Argon Asset Management. Ruan, in a nick of time, but thank you for joining us. Rowan, thank you very much for joining us, and you can start when you're ready. Thank you.
Thank you, BCI, for the invitation. Thanks, Eugene, for hosting the session. I noticed when I got here that there's little gifts from my employer on your desk. It's not because my performance is so bad that we have to sweeten you, okay? So I don't actually know about this. Right. There's been a lot of talk already this morning. You know, is the US going to have a hard landing, soft landing? Hard landing, soft landing. I thought I'd taken a wrong turn here and not come to an investment conference, but a urology conference. But anyway, you will see that I have no idea whether we're going to have a hard landing, a soft landing, or no landing, which is being talked about more and more. Also, let me just state for the fact, GDP in the US, China, South Africa is of interest to a lot of us for very good reason, but it has no correlation whatsoever with equity or bond markets, so you don't have to worry about that for investing. Okay, thanks. If I could go on to the next slide. Oh, I see I'll do it myself. So Eugene very kindly asked me to speak about my outlook. I'll then assess the merits of outlooks. Let's be clear, all of you would have been to many, many investment conferences, and by far the most common topic at any investment conference is the outlook. So I'm going to have a slightly different view on that. I'm going to prove that alpha is patently obtainable without forecasts. And then, of course, I'll review the two funds that we co-manage or co-branded with BCI. So I was asked to do my outlook. Here we go then. I'm terribly sorry, but I don't have one. Certainly not one of any use to you or to me. Thanks, Eugene. I'm done. I'm actually going to back this up, guys, seriously with some proper data. And I'm going to end up with a fiduciary observation. I would love to know Naspers' earnings as much as the equity guys do. I would love to know the rand-dollar exchange rate. Long time ago, I gave up and I abandoned doing those things. I can't do it. That's the bad news for my clients. I'm telling you, nobody can do it. I think our recognition of knowing what we don't know is actually quite helpful to our process. So, of course, I have, like everybody else, I'm a human being. I have instincts, I have feelings in my waters, but I do not inflict those on other people's money. And there's very good reason for that. It will come down to a fiduciary observation. I don't know about you, I'm not a masochist. I don't like to set myself up for failure. So I often know macroeconomic forecasts. I see this a lot in other people's outlooks. Look, I get all the sell-side research, so I see this stuff. How often do you read, the outlook is uncertain? So I invite you to remember Standard 8 Maths, a term called a corollary, the other side of the coin. Imagine some serious person said to you, the outlook is certain. Now that would be some statement. I mean, I would march him off to the lunatic asylum immediately. So if the outlook is always uncertain, where is the value in observing that the outlook is uncertain? I don't follow that logic at all, but it comes out all the time. And as for we expect future volatility, there can be no more asinine statement in all of investments. Of course there's going to be future volatility. This is just like hedging your bets. It's completely useless. I want to say one other thing on volatility. I hear so many fund managers and advisors and consultants whinging about volatility. Oh, it's been a tough time for volatility. Let's be clear, nobody in this room would have a job if there wasn't volatility in markets. Let's stop griping about it. Deal with it. That's what we do. I heard the last speaker say we're risk managers. Well, we're portfolio managers and risk managers. We live with volatility. Don't forecast that there will be volatility. Obviously there will be. Okay, some examples. I'd say none of this lightly. I will back up everything. I'm a trained statistician, so that's in my blood. Here is the dreadful record of South African inflation forecasting over 23 years. I do apologize for anybody who was in the seminar 2 weeks ago, the sort of online one. Apologize for some repeated material. On the other hand, I make no apology because I did not suddenly reinvent my entire investment thinking in the last fortnight just because I'd be standing here today. So, yeah, the red line is South Africa's inflation since we've had inflation targeting regime, 23 years now. The black line is where it was supposed to have been, and the blue line is where it was thought to have been 2 years prior. I've shifted the black line 12 months to the right so that it lines up with where the red line should be. When you shift a time series to the right, almost all economists call that lagging. Sorry, leading. Shift to the right, leading. That in itself is wrong. It's lagging. Stop and think about that. If you don't know a lead from a lag, I don't think you should be in the game of forecasting. As for the currency, I get inundated, like I'm sure all of you do, with forecasts on the currency. I estimate that 19 out of 20 South African economists misspelled the rand. In common with every other currency, it's not a capitalized thing, by the way. So you can just abort reading one paragraph in if it's misspelled. What sort of expertise are we going to have? Okay, so inflation costing, dreadful. America, even worse. I mean, it's just been forecasted 2.25% for decades, and it's nowhere near. Let's not take the private sector, let's take the central bank, Bank of England. There is this forecast. So starting at the bottom, the magenta or pink line was the forecast, and then it changed and changed and changed until we got to the bright green line. What's happening here is not any kind of improvement in forecasting. It is a pure reaction to the failed prior forecast. That's it. Now, I have 15 asset classes for you here. From the left, US large cap equities, then US small cap equities, non-US large cap equities, and so on. Bonds, developed market outside the US, emerging market, all the way down to private equity. These so-called self-declared forecast experts were asked about the range of outcomes. So the gray bar is the length from the most pessimistic to the most optimistic for each asset class. The orange is just the median or the consensus, if you like, sort of. So the orange dot is in the gray bar by mathematical definition. The yellow, however, is the result. Not one of these 15 classes, not equity, not fixed income, not property, not commodities, not developed market, not emerging market, was even within range. I think that's a profoundly important and quite worrying chart myself. So why do things go so horribly wrong in 2022? Everybody knows the answer. A Russian invasion of Ukraine and soaring inflation. Very aggressive monetary policy. So everybody knows that. There's no information advantage. There's nothing you can even do with that information. It's so well known. But here's the problem, guys. Every year something comes along that upsets these things. It's my 33rd year in the market, and I'm telling you that every single year. So then everybody's got a valid excuse. Oh, you can't blame me for my 2% forecast inflation. It turned out 800 basis points off the mark. That's not my fault. It's Putin's fault. But it happens every damn year. Think of the assassination of Chris Hani, the nuclear disaster in Japan, Fukushima. Think of firing of Nene. Think of the Twin Towers. So my point is, I can't forecast, but I think I'm in a kind of comfortable position of recognizing that I can't. And I'll come to this sort of philosophical angle of that in a moment. Now, we're asked to speak about bonds today. I managed equities for 20 years, so I like to think about those too. I don't suffer asset class bias, which most specialists do, by the way. What about bonds in South Africa? So we have this pretty sophisticated model, but luckily the output is not difficult to understand at all. I've decomposed the all bond index's returns over the past 10 years into some factors. Don't worry about the green line, there's no spread, that's for portfolios. The orange line is when we rebuild, recompound our factors, we end up with exactly the published return of the all bond index. So the mathematics of the model is precise. It's extremely intense as well, but it's precise. Now look at that beautiful upward sloping blue line. That is what I call the passage of time. Remember, unlike equities, a bond's price changes on a Sunday, on Easter Monday. These things are sure things. So even on a day with news and noise and volatility, there are certain kind of magnetic factors in bond pricing that were operating all the time, even on Sundays. That's the blue line. This is why it's called fixed income. The reddish line is the news and data announcements that cause changes in yield. First of all, you can see, I think, that the red line is as near as damn it a random walk as you can see. If I could just take a minute, the book, if anybody in this audience hasn't read it, I think one of the most important investment books ever written, A Random Walk Down Wall Street. You may know that it turned 50 years old last year, and the author was interviewed by the CFA Institute, and I managed to get a question posed to him through that way. A brilliant, brilliant book. But the red line is a random walk, guys. It really is. This development of news flow and its impact on the bond, and I can tell you exactly the same equity market, is random. So the outlook as things materialized was completely unusable. My point is, even if you had an accurate outlook, you could not have used it meaningfully. But look at the scale. I know this chart's quite far away. Because of the very well-established things over the past 10 years, most notably slippage in the fiscus, the bond yields are up 300 basis points over the past 10 years. That impact alone has cost 20%. So where the red line ends, if you can't see it, is 80. So it's down from 100 to 80, 2,000 basis points. We have paid for rising bond yields. That has not stopped bonds delivering a perfectly healthy 2.5% real return, as government bonds tend to all the time, because it's the other factors that do not need any forecasting that absolutely overwhelm the random flow of news. So our approach in active funds is to say, if I can get a blue line that's even more upward sloping and more convex than the benchmark, and neutralize the impact of the red random line, which is quite easy to do with a bit of maths, then I have secure alpha instead of hazardous alpha. That has been our approach, mine, for 30 years. Final word on forecasts. So, Ruan and I, you could force a gun to our head and say, what do you think American CPI will be next year? It's like 2.7, he's 4.3. We'll both be wrong, that's for sure. But even if my forecast was correct, it would have to have been in the minority, otherwise it would have been priced in. So now the burden of proof on forecasts is two things. You must be right, and you must be the only one who's right, just about. This is ridiculous. You have to have a very seriously misplaced ego to think you can make a living doing that. Abandon it, it's foolhardy. So our approach is like no heroics, just a little bit of alpha all the time, which can work. I think, I'll jump to slide. That one ended up in, if you may, I'm going to go this one first. So the BCI bond fund, which we're delighted to manage, is only just over 2 years old. So for any kind of statistical merit, allow me to show you our GIPS verified, certified. So it's all approved by Deloitte, every single number in there. And a similar approach to what I did before, but now I'll break it down even further into factors. An equity style attribution for fixed income is a totally pointless exercise, by the way. It'll work, the arithmetic will work, but it will give you results that you can't use. So the gray smooth line is that stuff that we can harness with a high level of security, yield enhancing. The blue, dark blue, is the total alpha we've generated over 16 years. It's pretty consistent with 2-3 blips that you can see. I can explain each of those. Look at the yellow or golden line. Other than the days I was as reckless as a lot of people are, the yellow line is flat. In other words, we have used something called quadratic optimization to neutralize the impact of news and noise. I have obviated the need to forecast by mechanically adjusting the portfolio to not need it. That, I think, is quite important. And so it's 16 years of potent alpha. This is fiercely mathematical. So we'll leave it there. The interpretation is easy, but I will stick around for sure at the break, Eugene, for any questions. I've put it, people have seen this, and it's interesting, the actuaries at insurance companies. Okay, now, I can't be devoid of some thoughts, okay? So just so that I might ever get invited back to BCI, despite having no outlook, I will share some thoughts on valuations. This is very different to saying US GDP will be 1%. If I could just say a word about, Richard's left, the US yield curve. A word of warning. He's quite right that it's been good at forecasting recessions. But there's another side to it. It's also been terrible at forecasting recessions that never materialized. So it anticipates all forecasts, all recessions. It also anticipates a hell of a lot of recessions that never happen. That's where the famous quip comes from. The US yield curve has correctly forecast 12 out of the last 5 recessions. Okay, that's about right. We always have to do one more quip because I've got about a minute, I think. On artificial intelligence, I saw a lovely quote from a well-known American fund manager. Some people study artificial intelligence. I study human stupidity. And in markets, when you can see the bad behavior, the dumb decisions, you can sometimes harness that favorably for alpha, sometimes. So some thoughts. Look, the bond market, guys, is completely different to when I started, where it was, you buy or sell government bonds and you long or short duration. It now looks a hell of a lot more like equity research. Over my career, the equity market in South Africa has dwindled from 750 shares to barely 300. The bond market, listed bonds, has gone from 25 to very nearly 2,000. So a lot of our day is looking at the Shoprites, the Bidvests, the Amplats, the Implats, and looking at their listed debt. So it's totally different. And there is going to be far more mispricing somewhere within 2,000 securities than to say the US bond market is wrong. Okay? It's kind of fairly axiomatic to me. So some thoughts. Like I saw with Woolworths Shoprite earlier, working backwards instead of forecasting earnings, what's priced in? What's priced into the 10-year bond yield is an inflation rate a lot higher than will be tolerated by the Reserve Bank over the next 10 years, and certainly out of the 3 to 6. So if they just get it back into 3 to 6, bonds are going to look good. Don't condemn all SOCs with one brush of tar. Some, like the IDC, are actually very well managed. Some, where you have a government guarantee, are poorly managed, but offer really attractive yield spreads. There are some dripping roasts, old-fashioned term, low-hanging fruit dripping roasts. There really are some fantastic mispricing through illiquidity that can be harnessed. Bank debt has become all the rage. The 2 of the last 3 bank auctions, Standard Bank and First Rand Bank, the auctions were the most oversubscribed in South African history. For every rand on offer, there were bids of 4.5 times that. This has become a popular trade. We'll finish up. I don't like popular trades, crowded trades. I go back to 1999, you could only get standing room to go to the Dimension Data results, but if you went to De Beers results, you could have a one-on-one with the CEO because they couldn't find anybody else to attend. What happened the next year? Dimension Data started its 98% fall, De Beers went up 72% within 6 weeks of each other. Subordinated Big 5 bank debt in South Africa, we were into at least 8 years ago when it was a novelty under Basel III regulations. Now you can't move. So I'm backing away. Let the latecomers overpay for that. Property debt, patently too expensive. Most corporate debt is too. I mean, people have caught on that there's a whole world outside government bonds. This hasn't stopped us from assembling a portfolio that persistently has a yield and convexity advantage over the rest without invoking crazy forecasts. And now we do more and more bilateral. This is really fun stuff. It's kind of more like equity. In fact, it's a bit more like investment banking. I go directly to some of the smaller loan borrowers out there and I say, you're being fleeced by your bank on a bilateral loan. Speak to me. I'm going to show you how to go to the bond market, list a bond, and we will invest in that. And boy, is there some beautiful mispricing there. So it's fantastic stuff. And I don't give a toss whether the budget today, you want to forecast? Your sin taxes are going up. Your fuel levy is going up. I won't even be listening. If I could finish with the most offensive comment that I get bombarded by the sell side all the time. Today, all eyes will be on the budget. Bugger you, my eyes won't be on the budget. Just speak on my behalf. It's a completely pointless thing to listen to. The result is a foregone disappointment, okay? Okay, so this fund's only 2 years old. It's miles ahead of its actual benchmark. It's second quartile. There's some performance stats for you. The short-term income fund, even further ahead. I assure you, not in the past 16 years or the 2 years of running the 2 BCI Vernani funds was anything so hazardous as forecasting. So my final word is a little bit heavy duty, kind of philosophical. We know that human beings cannot forecast financial market variables. If you think what I've shown you on macroeconomics and bonds is bad, that stuff is as sharp as a surgeon's laser compared to forecasts in the equity market. Company earning forecasts 1-2 year out are really scary. So I have taken the view that I would be acting outside of my fiduciary responsibilities to my clients if I inflicted private forecasts on their portfolios. That's why I've obviated it. And it works fine. And I feed up from all sorts of things like worrying my pretty little head about Jackson Hole, the next Jackson Hole meeting of the Fed. I could care less about Jackson Hole than Jackson's Hole, actually. Foreign flows is a South African obsession, like no other country in the world. Foreigners own far more US government bonds than Americans do, but you don't see them concerned. Foreigners own less than 40% of our bonds. I want to state something controversial. Despite widespread belief, buying and selling of South African bonds or shares does not impact the prices. Fact. I will show you the evidence. But it seems that everybody likes to believe that. So a lot of what I've done is not adding to another doomed forecast, but disproving a lot of stuff that is taken as conventional wisdom. Conventional wisdom is, of course, an oxymoron. If it's conventional, it's not wise. Just like military intelligence. Thanks, Eugene.
Good morning, everybody. Thank you for this opportunity to talk to you. One of the interesting things about looking at history is that while it's quite clear how things have ended, it's a lot less clear where things began. So take, for instance, the falling financial markets in the global financial crisis of 2008. To understand that, you would need to understand the subprime mortgage market. To understand the subprime mortgage market, you would need to have an understanding of the 30-year trajectory of falling interest rates. That in itself would require an understanding of the inflationary period of the 1970s and the acts of Paul Volcker to fight inflation. That inflation episode, you would have to understand the Vietnam War, its after effects, loose monetary policy. To understand the Vietnam War, you probably would have to look at the West's fear of communism in the aftermath of World War II. And so this is how it works when looking at events. You can trace them back endlessly, seemingly. But often, if you dig deeper, you get to what is called an epochal event, a big event that seems to inflict various other seemingly unrelated events. And clearly, World War II was one of those events that shaped the world. I mean, it gave us radar, it gave us penicillin, it gave us an expanded workforce of women, atomic energy, to name many, many more things. COVID appeared to be like a war if you listened to politicians. And it makes sense. You want to mobilize people in a war. I guess, ironically, you were trying to demobilize people through COVID, but really trying to get support for the frontline workers. War is part of a collective memory, reminding people about concepts such as duty, service, etc. So we had policymakers, politicians speak of COVID as a war. Might not be the most apt description. There's various criticisms. It might not have been useful, but we're not here to debate the merits of whether COVID was like World War II or not. What we're here to talk about is the similarities in the economic policy. So clearly, What we saw during the COVID period was simultaneous loosening of monetary and fiscal policy. We had fiscal transfers to the public that created this climactic moment in what was a long-term debt cycle with debt levels rising and rising. And this is a common theme throughout war. Unconventional monetary policy, fiscal dominance over monetary policy. And why does that matter? Because the biggest question of today is inflation. Don't worry, I'm not going to try to forecast inflation. Why is inflation so important? Clearly, it impacts monetary policy, and monetary policy and the policy rate represents the apex of the monetary system. It is a number one macro variable where the policy rate is going in terms of the monetary system. And inflation impacts asset classes, as we know. Its impact on bonds is quite clear. Bonds have an unexpected or have an expected inflation embedded in them. It has an expected real yield and a bit of risk premium. You get an unexpected bout of inflation, that yield rises and prices fall. The longer duration the instrument, the more it falls. Equity is a little bit less clear than bonds in terms of inflation's impact, but uncertainty of inflation makes long-term economic planning and contracting difficult. And the monetary response of monetary tightening typically will reduce demand further out, which reduces cash flows. And then commodities themselves are usually a cause of inflation. The problem with the last 30 years of data that we have is there has not been many experiences of these kinds of inflation episodes that we saw last year. And we saw the impact it had on monetary policy, on stock prices, and on bond markets. So if you look back a little further, you go through 100 years of history and look at various inflation episodes. In this case, we define an inflation episode as inflation at 5% and rising. And then you get other regimes where inflation is below 5% or falling. And let's look at how asset prices and various strategies performed. The first bar, the big green bar, is how energy commodities perform during an inflationary episode. Clearly, you're getting strong real returns of 41% annualized from energy prices or energy commodities, because they usually are the cause of inflation, oil price shocks, etc. Another popular or less popular but successful strategy is trend following, buying stuff that's going up, because information is not always in the price. Information reaches the price slowly. You have quarterly committee meetings of pension funds who would decide to assess what's going on, reallocate. Information hits the market over time. That's how trends build on themselves. You also get the behavioral biases of fear of missing out, wanting to catch the latest trends. So clearly trend following has worked very successfully in inflationary environments, returning 25% annualized over those periods. And last year, trend following strategies were the best performing active strategy out there. Commodities obviously would perform very well in inflation. So does gold. Equity trend following, less successful than trend following across all assets, but still generating positive real returns. Your US inflation protected bonds generating just 2% over inflationary periods. Value equities will lose value during inflation episodes with a -1% real return over the period. Safe as houses, not quite. Residential property loses 2% during inflationary episodes. Clearly, US Treasuries, both 2-year and 10-year, lose money in inflationary episodes, and the 10-year actually loses money over time, irrespective, although it is a countercyclical asset, so it has some value in a portfolio. And finally, the equity market is where you are pretty much certain to lose money in an inflationary episode in real terms. So not only does it matter for asset prices, whether we're in high inflation, low inflation, etc., it also matters for portfolio construction. One of the key determinants for risk in a multi-asset or a balanced portfolio is this correlation between equities and bonds. It's what's given rise to the balanced fund, to risk parity strategies that have observed over the last 30 years a negative correlation between bond prices and equity prices. When there's a shock to the system, equity prices fall, but at the same time, we start to discount the Fed put. That's going to strengthen bonds. So your bond allocation typically would offset your equity allocation. But again, if we look back beyond 20, 30 years, we see that this correlation is also regime dependent. And a lot of work has shown that this correlation is dependent on the level of uncertainty of inflation, which is also usually related to the level of inflation. So high inflation typically would mean high inflation uncertainty. And you see this period from 1965 to 2000, there was no value to really be had in diversification across bonds and equity. It's an open question whether we are back in a positive correlation regime. Clearly, the second half of last year was positively correlated for bonds and equities, but much of this would depend on the unforecastable. What shocks we have into the supply side, how monetary policy is conducted, what mistakes or errors come through from that side. But this is something to keep in mind with respect to portfolio construction. Don't assume the negative correlation. That was just a feature of a particular regime. I think Rowan's covered this quite clearly. There is no crystal ball for inflation. This is a chart of the ECB's forecasts. Now, this is an entity that's tasked with maintaining the monetary stability of the Eurozone, to keep inflation below 2%, but near 2%. And even they are unable to forecast inflation a year out. So what hope do we have? But again, we can look back at a history of inflation. This goes back to the post-World War II period, where we look at various inflation episodes. There are only 6 or 7 of these episodes to really speak of where inflation got to 5 and beyond that. But it's worth examining and looking for some commonalities across these. Episode 1, post-World War II, after price controls were lifted, you had a lot of pent-up demand, you had supply-side issues. Sounds a lot like the current situation. Inflation rose to near 20%. Episode 2, the Korean War. As the US entered the Korean War, people had vivid memories of supply shortages, of the requirement to stockpile. That drove up prices. And then we had episode 3 and 4 during the oil price spikes, first with the OPEC embargo and then with the Iran revolution, Iran-Iraq war, war featuring again in a high inflation episode. And then you get to episode 5 and 6 more recently. Episode 5 was more of an overheating type of economy, but also episode 6 was high oil prices, with the US seeing gas prices skyrocket. Oil went from $70 to $140 a barrel around 2008, middle of 2008, and we had an episode of inflation. And over this time, the understanding or academic understanding, policymaker understanding of what drives inflation also went through various fashions. In the 50s and 60s, it was about labor bargaining. In the 70s, it was about monetary policy, monetary aggregates. Milton Friedman, who would say inflation is always and everywhere a monetary problem. And then post-90s, we sort of went into this Phillips curve, unemployment drives inflation, inflation expectations drives inflation. We don't know what causes inflation. The academics don't know what causes inflation. They keep revising these attitudes. But what we can study here, and what might be of use, is looking at these previous inflation spikes, like what we've had in 2022, 21, and look at what happened thereafter, because we seem to be in a disinflation process. The Fed Chair Powell says we are in a disinflation process. It has begun. So let's look at these episodes, where inflation came from, and how long did it take them to fall, and how much did they fall? So as you can see here, the duration of these disinflation processes could be as short as 12 months, which was the 2008 example, or as long as 46 months going to the Korean War. So it seems like we are somewhere on the shorter side of this duration. Inflation in the US has been falling now for 7 months. It's fallen about 2.7% from 9.1 to where it is right now. This shows the extent of the inflation fall. 22% fall in the World War II period, 7.7% fall in the 2008 inflationary period. At this point, we've only fallen 2.6%. So it seems probabilistically that we are still in the disinflation process, and it has some way to run. And this matters because while we cannot forecast what's going on in the markets, what we can observe are various hypotheses that are competing at all times to create price formation. You would have a hypothesis that says we're going to get this immaculate disinflation. That was in vogue earlier this year, seems to have fallen out of favor now. Now we're concerned about sticky inflation. Inflation is going to fall and rest where it is. If you look at these previous disinflationary processes, it's probably a bit early to be subscribing to that thesis. I think it gained a lot of currency after CPI printed north of expectations in the US in the last print. When we look back at disinflationary cycles, we find that your economic forecasters misestimate the previous inflation print 40% of the time. You get 40% of the time, you get upside prints in inflation in a disinflationary process. And this causes people to start to assess, is inflation really falling? Is it going to stop? So what we like to do is look at the various hypotheses competing at any given time and look at the probabilistic skews. So relative to history, what we can see here is we are mispricing the probability that disinflation continues for a period of time, as it has done in post-war periods. So that can be turned into a tradable idea if positioning suits. So we like to think of markets as complex systems. And what happens in these complex systems is you've got to look for diversity breakdowns. You've got to look for situations where everybody's on one side of the boat. And all it takes is a small change in data, a downside CPI print, for everybody to revise their assumptions, and everybody's trying to get out to the other side. One of the ways to look at this is to look at indicators of sentiment and positioning, and we've got a number of these, but this is just one example. This is the bull-bear ratio by the American Association of Individual Investors. This index caught our attention. It was in 44 weeks of bearish territory. That's the longest stretch of bearishness that this index has ever experienced. So then we start to look at some back tests. How do markets perform after we come out of an extended period of everybody being on one side of the boat? Very bearish. It's quite varied, but 75% of the time, your 3-month return on risk assets going forward is positive, with an average return of 4.2%. There are some scary numbers if you cast your eye at this table, particularly in the 2008 period, where we had a 3-month fall of 30%, and during the COVID period, the post-COVID period with a fall of 12%. But what this is telling you is that there's a skewed opinion to one hypothesis. And this hypothesis is that we're going to have sticky inflation. We might. If we do, it would be the first time in this 100-year period of high inflation episodes. And mathematically, it makes sense for disinflation to continue for a period of time because of base effects. You're always comparing with a year ago. So we cannot forecast or predict where inflation is going to go, but our assessment at this point in time is that there's a bit too much pessimism baked into expectations and into the price, and there is an opportunity for a shorter-term 3-month engagement in risk assets. Beyond that, it's up to the shocks that might occur that we cannot predict. Thank you.
Thank you, Rowan and Ruin. Unfortunately, not time for questions. We're trying to win a little bit of time. You both mentioned you are here for tea time. I don't know for lunch as well. If you do have questions for either Rowan or Ruan, then please speak to them after tea time. Right, our very last session before tea time, a very important session as well. Only another 15 minutes. Be with us. We're going to have lovely tea just now, but very important is on global property. So if Martin Buerta can join us on stage from Reitway on global property. And my question to you up front, if you look at behavior, you can come up. Don't be scared. Behavior of global property, is it an equity or is it a bond? You'll answer both. Thank you, Martin.
I'll try my best. Thanks, Eugene. Good morning, everyone. And firstly, thank you to BCI for the opportunity to take part in today's event. And to all the attendees, I hope I can share something worthwhile or worthy of your 0.25 CPD points in the next 15 minutes. So in terms of today's agenda, I'll start off with the listed real estate opportunity. Then I'll talk about REIT performance versus equity markets during different economic environments. I'll touch a bit on real estate fundamentals, and then I'll end off with our fund positioning and outlook. So 2022 was an extremely tough calendar year across markets as well as asset classes. So as you can see, US bonds declined by 13%, US equities by 18%, US REITs by 25%, but private real estate still managed to deliver a positive 5.5% return. So you can call us biased, but we believe last year's underperformance was undeserved, given REITs' relative resilient earnings versus equities, their growing dividends versus bonds, as well as the fact that they own similar assets or higher quality assets than private real estate landlords. But we believe last year's dislocation has created a very attractive entry point for the asset class. So at the turn of this year, US REITs were trading at a 24% discount to NAV. So we went back into history to look at asset class returns following a 20% discount to NAV. And as you can see, relative to equities as well as private real estate, 3 and 5 years after a 20% discount to NAV has been breached, the asset class delivered very strong absolute as well as relative returns. And given the very strong fundamentals that I'll talk a bit in a few minutes, we do expect a similar setup for the asset class over the next 12 to 24 months. So moving on to the impact of inflation and interest rates on REITs. This was a study published by the National Association of Real Estate Investment Trust, where they looked at REIT returns versus S&P 500 returns during different inflation periods. This goes back to the 1970s, and for low inflation, they focused on inflation readings of less than 2.5% and high inflation of above 7%. And as you can see, over the last 50 years, during moderate and high inflation periods, the asset class has outperformed equities on average. And going back to the start of 2021, where inflation started to breach this 2.5% threshold for the first time in a number of years, global REITs have still managed to outperform global equities by 4.5% on a cumulative basis, and US REITs outperform the S&P by close to 9%. We also looked at REIT returns when there's a short, sharp upward movement in bond yields. So going back to the 1990s, typically when there's an increase to the magnitude of 0.45% on a monthly basis in your 10-year yield, you get this knee-jerk reaction where bond yields go up and property prices go down. And on average, the asset class underperforms equities. But 3, 6, and 12 months later, when the rate volatility subsides and investors' attention shifts to asset class fundamentals as well as valuations, you can see that the asset class delivers very strong relative returns. Given the rapid monetary policy tightening that we saw last year, and the fact that central bankers are communicating that we are getting closer to restrictive territory, I think it's relatively safe to say that we are nearer to the end of this rate hiking cycle than the start. So we also went back to the 1990s and looked at REIT performance versus equities 6 months after the last rate hike. And as you can see, the asset class has performed remarkably well. So the point at which the Fed or other central bankers stop raising interest rates has historically been a critical inflection point. Lastly, we also came across a study published by Cohen and Steers, where they looked at REIT returns during different economic environments. The most favorable one for the asset class would be where growth is increasing or high, but yields are also declining. We can see since 1990, the asset class outperforms equities quite substantially. At the same time, when growth is increasing, but yields are also higher, the asset class still delivers positive returns, but it lags the overall equity market. So with the benefit of hindsight, and even though unemployment is still at very low levels globally, last year can be characterized as a more stagflationary environment with lower growth as well as higher yields. And this is where the asset class suffers, specifically relative to equities. But given the fact that we believe recession fears will intensify as the year progresses, and there might be the so-called flight to safety, given very attractive bond yields again on a global basis, we believe yields, longer-term yields, might drift slightly lower. And at the same time, the cumulative tightening that we've seen over the last 12 to 15 months, we believe will work its way through the economy, so we still expect a very low or stagnant type economic growth. And typically when we transition from a stagflationary to a stagnationary environment, you can see that this is once again a very favorable economic backdrop for the asset class overall. So moving on to real estate fundamentals, I'll quickly touch on demand and supply as well as balance sheet management. And on this front, looking at occupancy rates, you can see all-time highs for the apartment, retail and industrial sectors. The only sector that's still lagging is offices with very high vacancy rates. Just to briefly touch on the global financial crisis of 2007 to 2009, you can see very sharp drops in your more cyclical property types. Retail, industrial, and office occupancies dropped quite considerably, but apartments, as a proxy for residential, had a muted drop. So going into a period of economic uncertainty, we believe that your need-based type sectors, which residential forms part of, can deliver more stable operating results, and then stock prices, we believe, will ultimately follow. Looking at real estate supply growth, it has decelerated quite significantly versus long-term averages over the last 2 years, and this is principally on the back of rising construction costs. Construction cost over the last 12 to 24 months has increased anywhere between 30 to 50%, making developments less profitable. While supply growth is expected to pick up in 2023, we believe it will remain well below the long-run averages. And in the sectors or markets where we see excess supply, we have positioned our portfolio accordingly to reduce exposure to companies we might believe might struggle with occupancy pressure as well as lower rents if the markets experience excess levels of supply. Balance sheets remain in great shape. Debt to total assets has declined significantly over the last 2 decades, going down from over 50% to the current 35% level. And then term to maturity on debt has also been extended quite significantly from 5 years during the global financial crisis to the current 7 years. Moving on to fund positioning. We remain firmly focused on REITs with strong balance sheets, with ample liquidity and access to different sources of capital. We're actively avoiding companies that we believe might be forced to issue equity at very dilutive prices. Once again, focusing on companies operating in sectors or markets where demand is outpacing supply and the landlords have the pricing power. And as I mentioned before, a need-based sector that tends to be less sensitive to economic growth, and that's also benefiting from secular demand drivers. And we believe companies operating in the residential, medical, logistics, data centers, and self-storage sector really ticks a lot of these boxes. Very attractive valuations, the best balance sheets out there, record high occupancies, as well as very strong rent growth. So between those sectors, you can see that close to 2/3 of our fund is positioned to take part in the secular demand drivers that we see in terms of e-commerce, the growth in mobile data, aging populations on the senior housing side, as well as housing shortages globally. Moving on to the outlook, we are more constructive on the sector in 2023 compared to last year. And this is principally on the back of very attractive valuations, strong fundamentals, as well as resilient earnings growth expectations. So just touching on valuations, at the start of this year, US REITs price to FFO or earnings multiples were trading at a discount to the S&P 500 versus a 17% premium last year. Global NAV discounts averaged 32% at the turn of this year versus mid-single-digit discounts 12 months ago. And then dividend yields are very attractive, 4.61% versus 2.99% at the start of 2022. We're not a yield-focused investor, we're more focused on growth, and dividend growth for our portfolio screens really attractive. For the companies that have reported results so far, we've seen dividend increases ranging from 9 to 22% in the residential sector, low double digits in data centers, and then our largest storage constituent recently announced a 50% dividend increase. We believe this dividend growth can continue over the next few years, given the very strong earnings growth that we've seen over the last 2 years, very conservative dividend payout ratios, as well as expected resilient earnings growth over the next 12 to 24 months. As I've mentioned, fundamentals will decelerate given a broader economic slowdown, but we believe they will move from great to good. And while supply is expected to pick up, we still expect it to be significantly below the long-run averages, affording the landlords in our portfolio the opportunity to raise rents higher than overall inflation levels. And then balance sheets remain in great shape. I think the last thing to really emphasize this year would be the resiliency of the asset class, or specifically earnings growth. While earnings estimates have been downgraded over the last few months for the sector, that downward revisions average 2.7%. But if you look at the overall equity market, a couple of months ago, S&P earnings growth was still projected to be at double-digit levels for 2023. But last year, the earnings estimates were revised down by 6.7%, and for this year, it's already been revised downwards by 13.1%. And in actual fact, we do expect them to deliver slightly less earnings growth than the sector. So given the attractive valuations, the very nice starting yield, the strong fundamentals, as well as the resilient growth, we do believe the setup for the asset class remains favorable going forward. Thank you very much.
Martin, thank you very much for that. Unfortunately, we're not going to take questions. We're really out of questions, but you are staying for tea and lunch perhaps as well. If you have more questions on global property, please do ask Martin about it. Maybe just a note from my side. Remember, on your global equity side, global equity managers does not look at global property. So if you believe that global property is a good diversifier for client portfolios and more resilient, if it were to be earnings down growth, then you need to include that as a building block in your client portfolios. Martin, thank you very much. We're going to break for tea till 11:25. I'm not going to steal from your tea time. So if you give me back here at about 11:20, 11:25, we're going to get going again with the fixed income managers and the rest from the day. And we'll try to make up time as we go along. And again, thank you for bearing with us during load shedding. I'll see you back so shortly. Thank you all for being back here at exactly 25 past. I really appreciate it. Our next section is on flexible fixed income. We've heard from the bond managers how attractive SA bond yields are. You've seen it in client portfolios over the past month, especially over the past 3 months. But if you're not sure exactly when to lock in yields, or whether to go for floating or fixed rate notes, or when to change over or manage duration, then we've got our brilliant panel here with us today that manage flexible fixed income managers that does all that for you. On stage at the moment, Bronwyn Blunt from Granite Asset Management, Brandon Quinn from Saffron Asset Management, Melanie Stockert from Laurium Capital, and Sydney from Caders Asset Management. Ladies and gentlemen, thank you so much for joining us here today. We're really looking forward to your presentations. Bronwyn, you can start if you are ready. Thank you.
Good morning, everyone, and thanks so much to BCI for hosting us today. I chose this title, Government Bonds or So, last year before the bond market sold off by 60 basis points. So things have changed. But I think the point of today's presentation is just to say that there are lots of sources of value in the income space. And today, hopefully, that will come through in the presentation. But before I start, just a quick word on Granite. You may have heard that we are all about the people. Culture is very, very important to us. It's sacrosanct to us, and we obsess about it. The values that are the bedrock of our culture means happy clients and happy people that work at Granite. The other thing that we value hugely is diversity. We've recently got to a BE level 1 as a result of all the work we've been doing in the skills development area of the scorecard, as well as other areas. We value people with all types of skills, not just your typical finance degrees. And we have engineers, philosophers, architects, etc. And we're very proud to say that 60% of our team is female, which I think is quite unusual for asset management. I think that the reason why we value diversity so much is because it does bring new perspectives. It means people can be themselves, and ultimately it means better decision making for our clients. Okay, now moving on to the interesting stuff. So the BCI multi-income fund at Granite has been going for almost 7 years now. It was launched in April 2016. We have had very consistent performance over time. We've had an excess of 2% above STEFI over all periods. And I think there are probably 4 main reasons for this. Firstly, we think it's very, very important to be flexible and nimble in the income space, diversifying across all asset classes, not just focusing on one particular asset class, but utilizing all of them. We do use duration, but it'll never be a binary bet. And I think what this means is that we have a limit in terms of our duration. We don't go above 2. We are cognizant of the interest rate risk that it brings into the fund, but we will harvest deals across the yield curve when we see value, not targeting a specific level of duration. And then we also do use credit. We have been investing in credit for many, many years, and we think it's a brilliant asset class for the income space because it does give you that yield enhancement above a floating rate type benchmark, which is obviously what an income fund is after, if you think about the cash plus returns it's looking for. And then finally, each and every asset that goes into this fund, we look at from a risk compensation mindset or philosophy, and that may mean different things for different asset classes, but essentially it's our philosophy that we use. We've also managed to achieve very good risk-adjusted returns. This graph just shows that. I think we're very proud of the fact that our Sharpe ratio is above that of the All Bond Index, as well as the return over the longer term. And this is not something we've targeted. This just means that we've been able to outperform the All Bond Index at a much lower volatility. If you think about the All Bond Index, what it achieves over time, it's around inflation plus 3, which is exactly what an income fund is looking for. To be able to do that at lower volatility is exactly what income funds should be looking to do. Okay, so hopefully this slide shows you how we look for many, many different sources of income in the income space. There are sub-asset classes within the income space, and they're all on the bottom of the slide. They're listed. And depending on the macroeconomic conditions at the time in the economy, we will be positioned in different ways. So it's our job to try and determine what the best asset classes to use, given the macroeconomic backdrop. You can see how the asset allocation has changed over time. For instance, we were very much in floating rate bonds at one stage, which is that pink area. But as other sources of value have emerged in the income space, we've moved into those asset classes. Now what's quite interesting is that the market has changed again, and what we expect to happen is because the yield curve has flattened so much, now the front end of the curve, in other words, floating rate type assets, are starting to offer better value. I spoke a lot last year about how we didn't like credit. We thought it was very expensive. We still think it's expensive, but we do think that there's a reason why you should be increasing your allocation to it in an income fund. Another area is the money market space. We think the money market space is starting to offer value, as well as offshore credit, which has emerged as part of our asset allocation at the top there. We also like inflation-linked bonds, so I'll speak a bit about inflation-linked bonds as well. So when I say government bonds or so last year, I mean there are other places to find returns. Okay, so the reason why we think that credit or floating rate type assets are now starting to offer value is basically because of real yields. So if you look at what our monetary policy authorities are trying to achieve, they want a positive real yield in the economy. That's a healthy balance to have, because then the accommodation that it can give to the economy when it needs that accommodation is there, as well as hiking rates when they need to contain inflation. Now you can see what's just happened is we've been in a negative real yield environment where inflation has been running ahead and the MPC has been taking time to catch up. So we've had the red line underneath what year-on-year inflation has been. So that has been the main reason why we haven't been investing in that floating rate space. It just didn't make sense really to be investing in kind of a negative real yield environment. However, now we see the SARB has reached its 7% neutral rate. Above that, we're getting to a positive real yield environment, meaning that if you add a credit spread to that, so if you've got a positive base real yield, you add a credit spread, you easily are able to attain inflation +3 again. Well, not so easily, but it's more easy. The problem is, obviously, is that credit is very expensive, and so you have to be quite selective in what you choose. But we are definitely seeing reasons why that floating rate area of an income fund needs to come to the fore. So that's the first thing. Secondly, we're seeing offshore opportunities that have emerged. And this is a great example. Last year, everyone spoke about government bonds and how you can swap them out to get a floating rate profile. This has shown how that opportunity has disappeared. We have two government bonds here, the 186 and the 2030, and their asset swap spreads, you can see, have declined quite significantly. So on an interpolated basis, we're probably at about JIBAR plus 100. Around there, if you had to asset swap both of those assets, versus the offshore credit default swap on South Africa for 5 years, which is a similar maturity on an interpolated basis, which is in excess, or has been in excess of 300 basis points. So we've been able to invest in offshore South Africa Eurobond risk and get that enhanced yield pickup, so JIBAR plus 300 around there, versus what you're getting on the local front, JIBAR plus 100. So a 200 basis point pickup, which we definitely think is an opportunity. If you extend that to the corporate sector, we've been able to find corporate credit that issue Euro bonds in the offshore market as well, like two of the names we've invested in are Bidvest and Anglo-American, also in excess of JIBAR plus 300. Because there's been this negative sentiment around emerging markets, obviously the Fed hike, the peak of the Fed hiking cycle is so uncertain, and all the uncertainty that's brought with it, emerging market bonds have underperformed. So as soon as there's that opportunity where they sell off, we can invest in those and receive that very nice yield pickup. And then inflation linkers. So we have not seen inflation-linked yields this high since 2003. I mean, we have yields on the linker side close to 5% on the long end and close to 4% on the short end. So if you think about investing in an inflation linker for an income fund, you are getting inflation plus. Your target is +3. If you're investing in a short end govie, you're getting that with your eyes closed, close to 4%. Now, people will say, we don't want to invest in an inflation linker because we've reached the peak of the inflation cycle and means that real yields are going to sell off. We actually don't care if we've reached the peak of the inflation cycle or if it's coming. If you look on a total return basis, what you're getting for short-end linkers compared to what you're getting on an NCD or another type of asset, there's definite yield enhancement there. And this is just because of a technical issue where linkers in the short end have sold off because they've fallen out of an index or something like that. So we found a lot of opportunities here. We've also added credits to these opportunities, so we've invested in First Rand or Standard Bank inflation linkers, and then you get an additional yield pickup. So in some instances, we've got close to 5% in the short end for these types of opportunities. So that's something that the fund has been quite active in, and we're now at about 17% in linkers. And then we have to mention good old government bonds. This is kind of a history of the rolling returns of the All Bond Index, and you can see how, the maximum negative drawdown over a year has been around -5%. The average rolling return, annual rolling return, has been 10%, which is inflation +3, which is how I started the presentation talking about that's what we're aiming to achieve in the income space. Now, if you think that the current rolling return is 5.3%, it's in the lowest quartile of rolling returns historically for 20 years. And if you think about what the majority of the government bond return is made up of, it's made up of its coupon, which is way above that 5.3%. Chances are that red line's going to go up. So there is reason to still be invested in government bonds. And this is besides all taking into account all the valuation models that we look at, where we look at it against US treasuries, et cetera, et cetera. This is just plain and simple where it is compared to history. And then finally, just our positioning. I think I've spoken through this, but we have reduced fixed rate bonds quite significantly. We were at close to 40% last year, moving more into floating rate bonds. As I said, we are positioned in inflation linkers. We've increased our offshore allocation to 4.5%, and we expect that to go up as well. We have a healthy position in money market. We also have increased our listed property holdings, and some of that does include offshore property, where we do have a very positive view on certain stocks, so it is stock specific. And then we do have a bit of exposure to hybrids, or A tier 1, as they're called, which is 7%, and that's mainly finding opportunities in the short end of the curve. Our duration profile, you can see, has gone up over time, and this is measuring the interest rate risk in the fund, but we expect that to come down as we see more kind of floating rate or short end opportunities emerging. It's come down a bit, but we expect it to come down more. And that's the end of my story. Thanks.
Okay, there we go. Yeah, thank you to BCI for the opportunity to present to you guys. I see lots of familiar faces. My name's Brandon Quinn from Saffron Wealth, based here just around the corner in Stellenbosch. We manage quite a few fixed income and diversified asset funds. Our opportunity income, which is our lowest risk fund, sits in the low risk quadrant. Our active bond fund sits in the medium risk quadrant. Our global income fund, which we recently launched, is a dollar UCITS fund based out of Ireland. We've got a qualified hedge fund, and our BCI flexible fund, which is an equity fund. Okay, so we've got more than 12 years of top investment performance, even though we're a small asset manager. We're a quants-based investment management philosophy. We utilize our quants modeling to blend various asset classes and to optimize a risk-adjusted return. We've got experienced investment professionals with north of 45 years worth of experience, I hate to say. And of course, we take a systematic, structured approach to generate replicable performance over the long term. Our asset size means that we are incredibly agile. We can move in and out of markets with relative ease. And of course, that means better efficiency in terms of price discovery and execution. I'm going to talk predominantly about our opportunity income fund in this space, but I'm also going to blend it with our active bond fund, which we think competes very well in this space as well. Our opportunity income fund has a benchmark of STEFI +2. It has an AUM of about 2.8 billion, and the portfolio managers are myself and Anina Swiggers, who's been with Saffron, an integral part of Saffron since 2013. There you can see we're available on most of the platforms, so don't waste time. Okay. The gross running yield of our opportunity income fund is sitting at 9.95%, which is reasonable. You would consider that as reasonably high, and that's with about a 15 to 17% pure cash holding. We're fairly negative on the market right now, so we are sitting on large cash balances to take advantage of opportunities as they present. Our active bond fund is on running yield of 10.16, and that's with about a 0.25 to 0.3 exposure to the All Bond Index. So significantly lower duration risk than the All Bond Index, but certainly comparable running yield. Importantly, and this ties in with what Bronwyn was saying, our gross spread over JIBAR on both of those funds is about 2.5%, and that's with significant cash holdings. That means that our ability to deploy that cash and amplify that spread over JIBAR is a very real possibility. The duration of our income fund is at 0.31, so very short. And of course, it was sitting at about 0.8 and even slightly higher prior to the sell-off in bonds. But we sold duration quite aggressively into this bond sell-off. Duration of our bond fund right now is at 2.21. And bearing in mind that the All Bond Index has a duration of 6. So significantly underexposed to the All B right now. In terms of performance, what we've done here, and I need to preface this with the fact that our active bond fund, which used to sit in this category, we've subsequently moved into the variable term category because we didn't want to have two income funds necessarily competing in the same space. But the active bond fund has an income core at its heart with a duration overlay. So I am going to use them by way of comparisons. If we're looking at our performance over 1 year, 3 year, 5 years, and 10 years, you can see that our active bond fund significantly outperforms the market, and we hope to continue in that vein. Our opportunity income fund, which has a cash anchor, and that is part of the recipe of maintaining very low volatility. Obviously, in a low cash environment, we would consider it as lagging at the moment, even though the fact is it still beats the average. As one considers more normalized cash rates, so pre-COVID type rates, you can see that opportunity income, the red bar, moves progressively towards the front of the queue as normalized cash rates start showing themselves in our asset allocation. And you can see that even over 10 years, our opportunity income fund even outperforms our bond fund, which outperforms the All Bond Index. So that's quite an interesting relationship of how you really can, in the multi-asset income space, generate comparable high duration returns with significantly lower risk. This is our active bond fund versus its current category, which is a variable term category. You can see that it performs very well. And I'll show you, more importantly, its performance in risk-adjusted space. On a 1 year return, like I was saying, our opportunity income fund is lagging its benchmark slightly, and that is because we're in floating rate notes. So our floating rate notes take a short time in order to reset against STEFI. Remember, STEFI reprices instantaneously. Our floating rate notes on aggregate in our total composition probably take about 1.5 months. So it's always 1.5 months behind the STEFI reset. If you have a look at our active bond fund, mind you, you can see that there are really significant outperformance over the All Bond Index over all periods. And yeah, so we would always suggest a nice blend between the active bond and the opportunity income fund in order to get that perfect mix. If we look at our fund returns in risk-adjusted space since inception, so these are 10-year time periods, you can see that opportunity income is right up there with other comparable peer groups, but also at a reasonably low volatility of 0.5. If we look at our active bond fund, and of course it really does perform there. Its risk-adjusted return is very, very attractive, with almost half the volatility of its peer group, and that's a track record we intend to maintain. Okay, third time lucky, fourth time lucky. There we go. And I jumped a few. All right. Inflation is obviously a very topical topic right now, and our ability to beat inflation is kind of proven over time. If we think about opportunity income, almost 90% of the time, our income fund beats inflation. And this is on a rolling one-year basis over 10 years. Interestingly, it beats inflation +3 more than half of the time. And inflation +5, 30% of the time. So 1 in 3 months, it beats inflation +5, if you want to think of it that way. How do we do this? Active asset allocation. We have an enormous exposure to floating rate notes, probably in the region of between 40 and 55%, and also a material exposure to offshore bonds. Our offshore bond exposure or offshore note exposure, we've maintained since 2019, and in fact, it's running very, very short right now. Our view on the market is that we expect higher volatility, both globally and domestically in the credit space. We think credit is too expensive, and we've allowed the book to run very, very short in anticipation of reloading credit at far more attractive levels. What else do you pay for? You pay for us to take active duration views, and we have a proven track record of being able to do this. Case in point would have been the recent, what we would have called extraordinary bond strength that we saw in the market. Those were profit-taking levels for us. We literally cut our duration in our active bond fund as well as our income fund to about 25% of our risk budget. And you will, if you have a look at our returns, you will see this recent bond sell-off hasn't affected us anywhere near the quantum of what the all bond index has suffered. Okay, our market view, more interesting stuff. Unfortunately, largely negative. If we think about South Africa and its structural position in the global economy, we are more sensitive now than ever to global flows. Our debt to GDP ratio of north of 70, and can you believe it? 2 years ago, we thought we would be sitting at 90%. So 70% feels good, but it isn't good. So our dependency on foreign capital flows is now larger than ever. And I suppose this is manifest in the fact that the government is looking to offshore concessionary finance as a source of funding rather than the overall market. Because I think the overall market wouldn't be as accommodative of further offshore debt issuances by the SA sovereign. And hence the concessionary loan market is probably, to give them credit, is the right way to go. We think that a premature cessation of the Federal Reserve rate hiking cycle would be a very big mistake. And history, for the Volcker era, would tend to support that contention. We also think, though, that the market has a high probability of misinterpreting the Fed. The Fed was behind the curve to start with. It was between 6 and 8 months behind the curve in terms of starting its rate hiking cycle, and it's likely to make the same mistake on ending it. The problem, though, I think, is that the market is too optimistic, is looking through the curve, has far too high growth expectations and normalization expectations than what we see in the market. Another important concept to think of at this point in time is just the concept of what is normal. Normal for us is not pre-pandemic. Normal for us is pre-global financial crisis. And in particular, if you think about the Federal Reserve balance sheet, it has a long way to go before it reaches any kind of normal levels. The impact of quantitative tightening, and I'm jumping to my second to last point there, will be a reduction in global liquidity. And of course, to the extent that it impacts developed markets, it's amplified in emerging markets. Other good news that we have today, of course, is the grey listing. I think a lot of that is already in the price, and I think it's mainly going to affect folks at an individual level, not at an institutional level. So it might be a lot more than, or a lot less than what's expected. Our credit rating remains a concern. You know, we in the double Bs, really to access cheap international funding, we need to be above investment grade. We've dropped out of the WIC-B, which means that those structural holders of our debt are no longer there. Typically, what that means is that the purchases of our debt tend to be more short-term, what we would call hot money. And those kind of flows will result in more volatility. If you think about what the bond market has done over the last 6 months and the volatility of the price action in the bond market, it has certainly increased. The daily vol has picked up markedly, and I think that's a symptom of a different type of player playing in our offshore market in particular. Load shedding and the impact of growth, I'm sure everyone's tired of hearing about that, but it's a very real consideration in terms of growth expectations. In our flexible fund, obviously there were results presentations over the last couple of days of the likes of Kumba, Amplats, and the problem there is that the higher commodity prices are not embedded in company returns. We've missed the boat. We've missed the beneficial impact of high commodity prices and translating that really significantly into company performance. Of course, we've got the budget today, the wage bill, the Eskom debt solution. That's going to be an interesting one, on again, off again, but likely to happen. I don't think they have much choice there. And of course, really importantly, at an overall asset level, we see risky assets as being far too overpriced, and that is particularly emerging market assets, far too expensive. The threat to that view is that in the US, the cash holdings have never been higher, I think, except after the Great Depression. So the danger to this view is that there's a wall of money looking for a home. And we think that there's a high likelihood that it can maintain or even push further inflated valuations. So that is a concern for us. And of course, this could never be more relevant is the geopolitical risks in the global economy. Russia withdrawing from the nuclear arms proliferation treaty is a really important thing to watch. And I think the heightened sensitivity to those kind of geopolitical risks is going to make for higher volatility as well as greater opportunities. So we are happy to sit on large amounts of cash. And if you ever look at our asset allocation, sometimes we sit on 15, 18% cash. But that is a strategy to avoid the volatility and to lock in yields at far superior levels. Okay, let's think about the dollar-FRA curve. The dollar-FRA curve right now, and this is the forward rate agreement curve. It represents a forward expectation of where interest rates are going to go on a quarterly basis. And you can see there that red line, that is the latest curve, is very steeply downward sloping. We think it's wrong. We think that the Fed is going to maintain interest rates at a higher level for longer. Why is this important? Because of our sensitivity in South Africa to global capital flows, the price of capital in global markets is therefore even more important. If we look at our FRA curve and the shape of that, it's pretty flat. We've got 1.5 rate hikes left, and then it flattens out. We think that it could become more normal as our FRA curve has to respond to the US cost of funds or policy rate curve. Back to my previous point, which is just the Rand's and South Africa's sensitivity to global markets. And this is just a rolling one-year return of the Rand in red. The others are various commodity indices. You can see that when you buy or sell the Rand, you buy or sell South Africa, it's just a commodity play. To the extent that we have given up the right to set our own policy because of our dependency on capital flows and because of inefficiencies in our extraction of resources, makes this relationship even tighter than it's ever been. So, when you're thinking about South Africa, when you're thinking about disposable income in South Africa, when you're thinking about the quality of our credit and our fiscus, these are the charts to look at because it's irrefutable. Okay, Just some interesting charts on dollar rand versus the oil price. You can see there where that red dot where we are right now. And really this is reflective again of our dependency of the global commodity cycle. We see the oil price between 75 and 85. I think that's a reasonable range. And what that does is it places the South African rand between 1750 and 1950 as a range. So I think that's a fairly broad range, but it does reflect the increased volatility that we're seeing in the markets. If we think about the All Bond Index versus oil, and of course the price of oil is a huge determinant of inflation, rates, etc. You can see there between the 75 and call it 85 level, and this is on a 6-month rolling return because we've had to shorten the period of the analysis in order to extract the sensitivity of the numbers. You can see that the All Bond on a 6-month return is about, call it 5%. We expect that 5% to decrease to lower levels, and depending on your duration positioning, after that, to actually return almost double-digit levels again on a 6-month basis, in line with our economic view. So the real message there is we believe over the next couple of months is stay shorter, but look to accumulate into weakness. Credit. Global credit, and here we're looking at the RTRAX, which is the black line. This is a diversified basket of European credits, and you can see that post the pandemic, those corporate credit spreads have compacted significantly, all the way down to the 400, actually about 376 basis points over plus the cash rate. What you'll also notice is that the MB, I think that's the MB plus, has retraced all the way back to pre-pandemic levels. And of course, the RTRAX, because of the geopolitical risks in the Eurozone and Ukraine, hasn't recovered back to its pre-pandemic levels. We also don't think it's likely to, and we think that there's going to be better opportunities in that area as well. So our entry into the European credit space is anywhere north of about 500 basis points over Euro cash. So these for us are selling levels with a likely reload in the next 6 months. If we think about the RAND curve, our RAND rates curve, we are sitting predominantly, obviously, with very short duration, but where we have appetite for duration, we see the steepest part of the curve, that 2032 area, as offering value. So from time to time, we will be loading up on that. And of course, relative to the swap curve, our government curve is offering significant value. The swap curve is very tight, and that's an expression of a deteriorating outlook on government finances. NCDs, we like the 1-year NCD. We've been buying 1-year NCDs into weakness. We don't think the 5-year is offering value here. So our positioning is really optimizing the short end, maintaining a decent running yield, whilst waiting for opportunities to present. And that's us.
Good morning, everyone. Thank you so much to BCI for the opportunity to present to you today. So I'm here today to talk about the Laurium BCI Strategic Income Fund, same space as my friends and colleagues on the panel. And we're talking about fixed income, so trying to make sense of what is currently a very complex fixed income world. And I often find, one of the best ways to approach that is let's talk about the things that we do know. So almost those known knowns going into the new year. What are the things that we are most certain about? So the first one is this idea of, on the global side, the new normal global monetary policy era has ended. We'll show you why. Secondly, our central bank, the South African Reserve Bank, is a credible and committed inflation-targeting central bank. We had more evidence of that in the current cycle. The third factor is that South African sovereign ratings slide. We've been on a big slide over the past couple of years. For now, that seems to have stabilized. And the last factor, you would have heard on earlier presentations that South African bonds are are looking relatively attractive. They definitely demand a risk premium. We'll tell you some of the reasons, things that we're worried about. But to a large extent, these risks are priced in. Some are to a great degree, some to a lesser degree, but there are a lot of risks priced into certain bonds along the curve. This is a time when there's so much uncertainty, both globally and domestically, to be flexible.
Melanie, apologies for that. All seems to be working again fine.
Thank you so much. We're learning resilience, that's for sure, South Africans. So, picking up on my train of thought, it was a cliffhanger. We need to be flexible in this environment as fixed income managers. We need to be nimble, but we need to be invested. We see extraordinary opportunities within our fixed income universe. We need to be nimble to take advantage and reduce risks when we think that risks are rising, but it's definitely a time when within multi-asset income funds, which give us a broader universe than a money market fund, with lots of opportunities we can take advantage of, but we need to blend them in a way that is much more conservatively positioned than, for example, a bond fund. This is fertile ground for us. Starting with that first point, which is really on the global side, this idea of new normal global monetary policy, which we all had to learn after the global financial crisis. What did this mean? It meant that since the global financial crisis, every single time the global economy had a growth shock or even a growth wobble, central banks responded by cutting interest rates, then cutting interest rates further, until we got to the COVID crisis, where interest rates in developed markets were actually at zero, and in some markets even negative. And we can see that by having a look at this chart. This shows us US interest rates in red, ECB in black, and Bank of Japan in blue. So you can see how successively interest rates just got lower and lower every single time. And then what we can also see if we have a look at the end is just how quickly all of this unwound last year. So from zero all the way up to significantly high levels. And if you look at the red line in the US, it takes us back to where we were at the time of the global financial crisis. So all of that unwound in a very short space of time. So this new normal global monetary policy ended if we look at short-term interest rates. What about 10-year bond yields? Let's look a little bit further out along the curve. Exactly the same story is present here. Here we've shown you US 10-year bond yield in red. You can see how we had this long rally in the bond market, lower and lower levels. In the COVID crisis, we had US 10-year bond yields trading at only 0.5%. That was exceptionally low. We knew that wasn't normal. And last year and the year before, completely unwound to the extent that we're now back at 4%, which is where we were global financial crisis time. So all of that unwound very quickly. Does explain, I imagine, to a great extent, why last year was such a terrible total return year for global bond investors. Let's have a look at two others. So Germany is a proxy for the Eurozone in the light grey, and then Japanese bond yields in blue. What's interesting there is you'll see that for the past couple of years, those actually traded at negative yields. I know that's something for us to get our heads around as fixed income managers, this concept of negative yielding debt. Obviously, both of those have snapped up significantly higher, both trading now in firmly positive territory. And if we just think for a moment about this idea of negative yielding debt, this is a proxy we use for global bond markets. It's the Bloomberg Global Aggregate Bond Index. And this is a dollar amount, but it shows you how much of the market traded at a negative yield over time. Clearly, that never used to exist, so there was nothing for a long time. And as these forces started to play out, and we were in this new normal, extraordinarily accommodative global monetary policy, it got greater and greater, that at the peak of the COVID period, 30% of this market was trading at negative yields. Extraordinary. And equally extraordinary is how quickly that is unwound back down to zero again. The last place we can look at for evidence of this new normal ending is, we were talking about quantitative easing earlier, and then quantitative tightening. Essentially, why did we have these extraordinary conditions? Central banks used interest rates, and then they widened their toolbox further. They started to use all sorts of tools, and they created new tools that they didn't have before. They bought bonds, they bought long-dated bonds, they bought corporate bonds during the COVID crisis. They got very creative, and they used their balance sheets to do that. If we have a look here, it's a Fed balance sheet as a percentage of GDP exploded as they did all of these things. They're now moving to quantitative tightening, and that is trending downwards. So further evidence that this new normal has ended. What does that all mean to us as SA bond investors? You know, this rise in global bond yields we knew was always going to be a headwind for us. It certainly was a headwind. We feel that a lot of that normalization has now taken place. We're not out of the woods yet. We still have some way to go until market has conviction that the Fed has actually peaked and is going to keep interest rates on hold. But we're certainly closer to the end of that cycle than the beginning. Second point we wanted to discuss was about our interest rate cycle. So our Reserve Bank, who sets interest rates, the SARB, we know they're credible and they're committed inflation targeting central bank. And how do we know this? Let's think for a moment what their job is. They keep inflation, South African inflation, between a range of 3 to 6%, but they target the midpoint, which is 4.5%. Because they do that, they need to act early. If we have an inflation spike, like we can see on this chart here, inflation, South African inflation is in red. Into 2020, 21, inflation was very, very well behaved, spiked up significantly when we saw the invasion last year, food prices and oil prices spiked up. Their job is to bring inflation, even though we have a near-term spike, is to bring inflation back down again over time. Did they do that in this cycle? Well, we have 2 points of evidence. The first one is in the red dotted circle, we can see when they started to increase interest rates. So South African interest rates in blue. The SARB started to lift, as any other central bank, they dropped interest rates like a stone during COVID, right? So we saw rates fall down to what were abnormal levels, 3.5%. SARB saw that as an emergency level, they were going to have to lift at some stage. When did they start to lift? If you look at the red dotted circle, you can see they started to lift interest rates while inflation was absolutely still under control. So they moved early in the cycle, like they said they were going to. And if we have a look at when did the US start to lift rates, which is the dotted line, sort of dark gray dotted line, their first hike was well after the SARB had already started to increase interest rates. What does this mean to us? It really means that for us as fixed income managers, we've spent a lot of time thinking about what the SARB is going to do with interest rates, both in terms of how to maximize returns out of our fund, but also when we're looking at long-dated bond yields issued by the government. Those are fixed-rate bonds. We have to have an idea of what we think inflation is going to be over time to determine whether we think there's good value or not. If you have a credible and committed inflation-targeting central bank, that gives you a lot more conviction when buying long-dated bonds. What is the third thing that we know? Sovereign credit ratings. When you're investing in SA government bonds, anything a little bit longer dated, you look at the credit risk of that issuer. We all know the tale of woe we've had as South Africa. One way to have a look at this is to look at credit rating agencies. They give us a score. The higher you are up on the scale, the better your credit risk. And you can see 2009, we had solid investment grade credit ratings from all of the 3 main rating agencies. We started to get downgraded. We lost our coveted investment grade credit rating a few years ago. We're sitting in firmly sub-investment grade territory. But the good news is that 2 of the agencies have our outlook on a stable outlook, and one actually has us on a positive outlook. The big caveat to this is obviously we need to stabilize our electricity crisis. And if we do that, we could start to move up again. Let's speak about the electricity outlook for a moment. Obviously, it's top of mind for all of us, but within the fixed income market, we spend a lot of time thinking about these dynamics. The good news is we've got an excellent plan. So the reforms announced in July last year and the energy plan that was put forward was excellent. It ticked all the boxes: stabilize Eskom, bring in new renewables, get the private sector crowded in, roll out rooftop solar, all of those things. That's exactly what we need to do. We don't need to have another plan. We just need implementation of that plan. And to show how powerful it would be, National Treasury in the medium-term budget in October last year, they put a little text box in where they put some numbers to it. And they said if we roll out that plan, we could add 14 gigs to the system within 2 years. 14 gigs, that's 14 stages of load shedding. Obviously that would work. We just need to get moving on it. So we're watching very carefully for signs of, is the momentum picking up? This can be slow moving in the near term. What do we need to watch out for? We spend a lot of time thinking about that. There will be some key announcements, hopefully in the budget this afternoon, tax incentives, everything at the margin will absolutely help us, and we need to wait for that momentum to turn positive. For one moment, let's just live in a world where we actually do get the electricity crisis sorted out. What would that mean for us as investors? Energy security would turn what's currently such a vicious cycle into a virtuous one. And how would it do that? If we look at the round circles, it would lift confidence, which would be fantastic. Why would that be fantastic? It would lift or crowd in private sector fixed investment because companies would be confident about the future. And we were speaking to the mining sector over the course of the past week. The mining sector alone has embedded generation projects of 10 gigs. They're in their pipeline, just take a little bit of time to roll out. That's 160 billion rands worth of investment. That could be quite powerful. How would that be powerful? It would lift our economic growth rate. High economic growth would reduce our fiscal risks, which would lift confidence, which would increase investment, and so on and so on. So we're not there, but this is something we need to be aware of. If we do start to see inflection points coming through, some of that risk premium might start to compress over time. Not there yet, we need the risk premium for now. So what is this risk premium? Why do we require it? We are fund managers. We worry a lot about a lot of things, as you would have heard today. What are the SA-specific things we worry about? Political risks are heightened. Further fiscal improvements from the levels we saw in October last year, probably pretty challenging. We're going to get a lot of information this afternoon in the budget on that. Our growth is just too low as a country. And global bond risks, still prevalent. We're not out of the woods yet. We still don't know when the Fed is going to stop hiking and when global risk conditions are going to stabilize. Is there a risk premium priced into bond yields? Should we be even looking at bond yields for inclusion in our multi-asset income funds? We don't have to include them. Do they warrant some inclusion? Well, let's have a look at some idea of fair value. So we know that bond yields, this is our 10-year bond yield, has increased. It's been rising since the COVID crisis. Are there any opportunities across the curve? We'll give you two examples. The first one is if we have a look at fixed rate bonds in the very short end of the curve. Here we've shown a 186 government bond and matures in 2026, so that's 3 years to go. That's a fixed rate bond. We look at that relative to what we think interest rates are going to do in South Africa. We're at 7.25 on the repo rate. We think those could increase a little bit further by another 25 to 50 basis points. But you can see that red arrow. There's still a risk premium you can take advantage of if you lock into fixed rates now. When the cycle does turn and we peak and the market starts to think at some stage about interest rate cuts, this part of the curve is going to perform very well. What about longer dated bonds? We obviously include these very cautiously within a multi-asset income fund, but is there value? Let's just think about this very quickly in two different measures. Trading at the moment, somewhere when we took this slide was 10.7. It's a little bit higher than that right now. Do you want to buy a fixed rate bond yield at 10.7%? We've got cash rates around about 7%. Does that make sense? If yields move sideways, yes, of course, you'll be getting a 10% return on a one-year view out of that. That sounds great. But what if yields move up? We know if yields rise, bond prices fall, how much must they rise until we're not getting a cash return anymore? So we do some maths there for you. Yields rise 1%, you're going to get similar and stay there. You'll get similar to a cash return on a one-year view. Yields have to rise by a full 2% before you're going to get a negative return on a one-year view. So quite a big risk premium priced in, even if yields continue to move higher. What about good news scenario? If yields rally a little bit, let's say only 0.5%, you could earn a 13.5% total return from some inclusion in bonds. So yes, we've spoken about the headwinds, we've spoken about the things to be worried about, but some inclusion with this risk return matrix in your favor obviously does make sense. Another way of thinking about it, 10.7%. What is the real yield that we are expecting over that period of time? We've got it committed. Inflation targeting central bank, they're targeting 4.5%. Let's just say that we have 5% inflation over the next 10 years, so they don't quite get that right. You're buying a fixed rate bond at 10.7. Your expected inflation is 5. You're getting more than a 5.5% real yield out of this bond. Yes, it comes with some risk, but at the same time, for that type of real yield, we normally have to go quite far down the equity risk spectrum to be able to harness that. So it's just some interesting food for thought. Obviously, we want to be cautious about our positioning within multi-asset income funds, but certainly when we're tactically looking to increase exposure, there are some interesting valuations on offer. How do we deploy this within a multi-asset income fund? This type of positioning, we use our duration management to express these views in the portfolio. Duration moves up and down, absolutely beholden to where we think value is in the curve, where we think value is relative to the other instruments in our universe. But you can see how actively we've managed duration over time. Because there's so much uncertainty, as we've discussed, global and domestic uncertainty, this is definitely a time when you want to be flexible, you want to have active portfolio duration management, and you want active diversification across all of your asset classes. So a quick snapshot of our portfolio as it is at the moment. We actively actively diversify everywhere we can. We blend fixed and floating rate exposure. Bread and butter of this type of portfolio is always going to be cash plus type instruments, lower heartbeat instruments, but we blend and diversify within that universe as significantly and as widely as we can. We do use the duration lever by adding some fixed rate exposure. We've got inflation linkers, was around about 8% when we took the snapshot. We find the middle end of the curve, I think Bron was actually showing some charts, really interesting valuations starting to emerge in the 5 to 10 year part of the linker curve. We've added that exposure to the portfolio since. Lots of opportunities at play, but at the same time we do have a automatic stabilizer by having some funds invested offshore. We were discussing how global bonds are, the value is definitely getting restored. It's looking a lot more attractive than it used to, and we're starting to utilize opportunities. Into periods of risk off last year, you would have seen us add offshore bond exposure into each of those periods. So how has this worked over time? Very, very briefly, we're very proud of our returns. We think that our returns stack up very well, both on an absolute basis in terms of what we're trying to achieve, but also on a relative basis to our peers in this space, who are often much larger than we are. So we're very proud of our performance over time. Fantastic. Thank you so much.
All right. Good afternoon, everybody. Thank you. Melanie is always a very hard act to follow, but I'll try my best. I've entitled my presentation Snakes and Rivers, and I know by this time in the afternoon we've been through all these presentations, so hopefully I can engender a little bit of interest in what I'm about to say. But let's start with the rivers. I'll get to the snakes in a second. When water flows, it seeks the lowest path, and then it also seeks the path of least resistance. So rivers follow this principle. But we've all seen that rivers can be quite destructive when they routinely flood their banks and suddenly change course. Now, the guys who study rivers, they call these avulsions. And it's often a slow buildup of sediment in the river, and that's the culprit, and that forces the river to burst its banks and change course permanently. And then environments and ecosystems must adapt to accommodate those changes. Now, this is really an analogy because financial markets and financial systems can be thought of as rivers that occasionally change course and sometimes change course permanently and can be quite destructive in the process. And if I look back over the recent times, I think COVID-19 can be quite a good example of an avulsion, where we all had to change the way we look at things, the way we had to work, hybrid working, the work from home, all the different ways in which you had to accommodate the COVID, for example. But just looking back in recent times, there's a few avulsions, I think, in the last year or so that we can look at that have required us to change the way in which we see things and the way in which we work with things. And the one thing that was on everybody's lips post-COVID in the last year or so was this global inflation surge. We've seen inflation surge quite dramatically. And obviously, as a result of the rate cuts that came about during inflation, we saw supply chain starting to heal. We started to see demand pick up. And then something had to be done because suddenly inflation was surging. Something had to be done. The river had changed course. And what had to be done was that the central banks had to step in. So they had to start their rate hiking cycle. And I think Melanie showed the one chart where the US and South Africa started hiking. But something had to be done because by that time we all realized that the river had changed and the central banks then were forced to act to try and arrest inflation. It's still happening at the moment. We haven't seen the end of it yet. We all know that the Feds might hike again. We all know that our central bank might hike again. So that's one avulsion that I thought if we could look at in the last year or so. The other one is the rising oil price. And I think we spoke this morning quite a bit about the rising commodity prices. And we've seen that we had supply fears coming through with the war in Ukraine. Supply chains suddenly were a problem again, and something had to happen because suddenly there was less supply than the demand that was coming through, and something had to happen. And what happened? Countries agreed to release their strategic oil reserves. We saw that happen. We saw it in the US and in other parts of the world as well. So to arrest the change in the river, to arrest the change in direction. And I think it was an important avulsion, if you can put it in inverted brackets, because it forced the financial markets to think about things differently. Another one that we can look at, and I think there are many examples, I think, in this last year, but one that struck me quite a bit was the sudden change in the UK bond and forex market. Now, this was all as a result of the unfunded spending by Liz Truss, short-term in office as a prime minister. And suddenly the UK bond market went ballistic, the forex market went ballistic, and everybody started panicking. And what had to happen? Something had to happen to recognize that this change has happened in the course of this particular river. And Liz Truss had to resign as prime minister to bring some semblance of normality back to the environment. But I think these are important little events, and there are many of them that I can think of. I'm not going to go through all of them, but we had the technology companies, we had cryptocurrency. Everybody went into a panic as far as cryptocurrency is concerned. And there are quite a few that forced us to sit up and recognize that there's a change in the course of this financial markets and financial systems on a global basis. So financial markets are most certainly complex. It's not simple. But at the same time, the markets and people are adaptive. When things change, we make a plan to adapt to what is happening. And we adapt to that dynamic and ever-changing environment. Because I think ultimately, the markets want to produce efficient outcomes. So one has to adapt. So, which reminds me of a story. So I'm going to tell you a story quickly. And goes as follows. Once upon a time, all stories start with once upon a time. In British India, the city of Delhi was overrun by cobra snakes, right? So the authorities devised a plan, and they said, for every dead snake that was brought to the authorities, they would give you a cash reward. And the plan worked very well for a while, but soon the authorities realized, hang on, there's a problem here. By this time, or after a certain period of time, the snake should have been eradicated from the city. So what was happening was the people were breeding snakes in their backyard, okay? Because a dead snake, cash reward. So obviously the authorities canceled the scheme, and the people released the snakes back into the streets, and the city of Delhi was overrun with more snakes than before. What the story illustrates quite clearly is the law of unintended consequences. But also what it illustrates is that people, in this case, and systems adapt to the changing of circumstances, of environments, and even the rules as far as this is concerned. But let's bring it home. I'm here to talk about our fixed income environment and what the outlook is. That's the brief I've been given. So just a few points in terms of looking ahead. And what we see, I think growth is quite important in our local environment, so I'm just going to bring it home. We all know that we're in a low growth environment. We all know that we've got high unemployment. We all know that we've got low business confidence. We all know that we've got low consumer confidence as well. And these are all factors that feed into our growth environment and is forcing our growth to be quite subdued. And I'm not going to even talk about Eskom and the electricity issues that's been spoken about enough, but that's feeding into a low growth environment, the declining growth environment. And that effectively, theoretically, that means that yields must be kept low. You know, is this going to be the case? And I think let's look at this quite carefully in going forward, whether that's actually going to be enough to keep yields low, because effectively we need growth in our environment, so in our financial environment. But theoretically, it's there to keep yields low. Let's not harp too much on inflation, because a lot has been spoken about inflation. Is it peaking at this point in time? We are of the opinion that it is topping out. Now, everybody's saying, especially South Africa or even globally, that inflation is peaking and it's coming down. Yes, it must come down because it's mathematical. It's base effects. We're coming from a high base fix. So it's in the numbers. I can tell you this for free. It's going to come down because of the numbers. But I think one has got to look through all of that. And some of the speakers on stage were quite eloquently explained how that all works. And look at core inflation. Look at the factors that have got upside the risk in the environment. Somebody this morning said on stage that food prices are rising. And that is putting upward pressure on the inflationary environment. So by merely looking at the number, it will tell you a story. But let's just be vigilant and diligent in how we actually interpret those numbers. There is still upside the risk in inflation, which will elevate yields or keep yields higher. The currency, of course, is quite an important fundamental, especially in our process that we look at when determining the directional movement of interest rates. And quite rightfully so. I don't think any of us know exactly where the currency is going to end up. But of course, it's quite a volatile at this point in time. As an emerging market currency, we've got one of the highest implied volatilities across the globe at the moment. And of course, we've been experiencing weakness lately. Dollar strength has come through quite a bit, and our local currency has experienced that weaken, and it tends at times to influence the short-term thinking of our fixed income environment, such as our bonds. We've seen our bonds weaken, and it looks like our currency tends to influence that at certain points in time. Now, the other thing is monetary policy. I think this is important because it sets the tone for where interest rates are going to go. And are we hitting the top of the monetary policy cycle? You know, we most certainly think that there will be perhaps one more rate hike before there is a pause. And I think this is really, we must understand this is the way that the central bank is trying to do their job to arrest inflation. It's one of the tools in their toolkit to use the repo rate to arrest inflation. But also there's a lagged effect. They started already a while back, as Melanie showed quite nicely with a little arrow on a graph. And that lagged effect still needs to come through. And I do think we're at the top of that cycle at this point in time. Okay, just one more thing in terms of the few factors that we look at, or few of the factors that we look at in determining the interest rate environment and the directional movement of interest rates, and that is, are bonds offering value? And I think, Rowan, I'm in your camp here. Nobody really knows. We've got a Fairview model that looks at things like the US 10-year and inflation differentials and all of those good things. But in the last week, I looked at 5 different models. They gave me 5 different answers. So there's no clear-cut silver bullet that is going to tell you where fair value it is. I do have a bit of difficulty with that term fair value, because what is it really? Is it really perhaps just a mechanism to justify so that ourselves that we feel good when the yields hit a particular spot on the curve? Or I think one's just got to be careful of trying to be too clever in establishing where fair value is as far as a bond is concerned. So I've been asked to look ahead, and there's many things. I can talk about lots of things that influence the directional movement of interest rates, but of course there's the budget today, and we're looking at the fiscal environment, and my colleagues have already spoken quite a bit about it. We've got the real possibility of grey listing. So what does that really mean for us? Are we going to be in an environment where we're going to have to really struggle to get out of that? What does it mean for the rating agencies? Are they going to be looking at us differently? And is it going to add to the volatility into our market? Most certainly, I do think that will be the case, at least on the short term, as a knee-jerk reaction. The political risk is escalating as we go into next year's elections. And then, of course, load shedding, as we saw this morning on 2 occasions, is going to continue. These are the things we know, okay? But as the local river traverses the financial landscape, there's always going to be these avulsions and events that's going to take place that could potentially force us to think about things differently going forward. The global environment is no exception. IMF said growth has got to be at 2.9% for 2023. You know, once again, a forecast. Is it really going to be there? I'm sure it's going to be different when we get to the end of the year. the World Economic Forum came up with a very nice term called, they said, this is the year of the polycrisis, where risks are more interdependent and reciprocally damaging than ever. It's just a very clever way or fancy way of saying that there are so many risks in our environment at the moment. And if these risks actually intertwine and work together, it can be quite damaging. I quite agree on that one. So we still got the energy supply crisis, and we've seen the move of governments worldwide moving towards more sustainable and secure energy systems. Japan has got its policy. China's got quite ambitious targets. And I think that, of course, we know that recessions have been spoken about quite at length today, so let me not beat that horse, but those geopolitical risks does imply that we are close to potential recessions in one shape or form. And then, of course, the Fed, we all know, is always poised to raise rates right now, because especially all the rhetoric that's most certainly coming out of that area. So, having said that, I'd like to just spend a few minutes or a minute or two on our products that we have at Cadiz, and using all this information. One of our products that's quite popular, our fund, is our Enhanced Income Fund. It is a fund that's benchmarked against the STEFI called Deposit Plus 1%, the Reg 28 compliant fund. But we use all of this information to try and achieve the objective of the fund. I think that's very important. If you don't know where you're going, then any road will take you there. So most certainly this fund has been a fund that's been designed to use the various components within the fixed income environment to achieve that end. It uses diversification to as much as possible. It's been designed to accommodate all market conditions. And we also designed it with the express objective of having low variability of returns and low modified duration to accommodate that low variability. It makes use, as my colleagues, it makes use of the tools that we have in the market in terms of nominal bonds, inflation in bonds. We've taken a position, maybe not as aggressive as my colleagues here, but also in inflation-linked bonds, floating rate notes, as we all agreed this morning, has got great value in it, so the fund has got a big chunk in that. And then, of course, there's money market instruments in there to provide the necessary liquidity. The proof, as always, is in the eating of the pudding. So once again, you feel free to look at the performance of the fund, but it's done exactly that in terms of beating its benchmark and, of course, its peers out there since its inception in 2014. From a risk-adjusted perspective, and the crosshairs on the peers within, or the average of the peers within the CISA category. The red dot is the fund itself, so it's very happy that it's in the top left-hand quartile, which means that you are maximizing your returns with having as little standard deviation or risk as possible. So, summary. It's not over yet. There's going to be volatility. Let's not be surprised by that, especially on the currency side. We're going to see potentially still some interest rate hikes, and inflationary pressures are still in the system. But be vigilant for the changes in the river. You know, it's sometimes difficult to spot those changes, because by the time it happens, it's too late. But be vigilant for that. But stick to your investment process if you have one, or you should have one. Stick to it. But be open to the changes. Let's not be dogmatic about things. Let's be open when the changes happen so that you can adapt to this change and reap the full benefit of making those changes. I thank you.
Bronwyn, Brandon, Melanie, Sydney, thank you so much for the session. Like I mentioned, we're not going to take questions. Unfortunately, trying to catch up a little bit on time. You are going to stay a little bit into lunch, but then you have to rush back to the office for the budget. Right. Thank you so much for coming through, and thank you for your time. Really appreciate it. Right. Coming to the stage now, last session for our day is multi-asset. And joining me now is Nick DeVos from Centaur Asset Management and Chantel Baptist from Fairtree Asset Management on multi-asset flexible and multi-asset low equity. Yeah, you're welcome.
Good afternoon, everyone. My name's Nick. I'm part of the investment team at Centaur, and I'm going to try and get through this as quickly as possible. I know we're keeping you from your lunch. So, topic is what if inflation is not dead? I know a lot of the speakers have spoken about inflation today, but let's just go through it in a little bit more detail. This is just Centaur's long-term track record. So delivered around 18% per annum, been around, if we get to October, for 23 years, and original investors in the fund are up over 40 times. And this is all net of fees. So just in terms of the topics I'll be going through, so just what the market's busy saying about inflation, sticky inflation versus headline or core inflation, different scenarios, and specifically how the S&P could perform depending on where inflation ends up, and then some of the ways that you could hedge against it, a little bit about our thesis on oil, and then just how we're positioned going into 2023. So this picture in front of you is essentially what the market's busy saying about inflation. So it's the US 5-year break even. It's the St. Louis Fed that puts this together, and essentially it's what the market expects inflation to be in 5 years' time. So around the January 2022 period, it raced up over 3.5%, and currently it's pulled back. In the past few days, it's up a little bit, around 2.5%. And that's versus the Fed's target of around 2%. In terms of a couple of the reasons why we think inflation might be stickier than what the market expects. So that red line there's another indicator that the Fed puts together, this one specifically from the Atlanta Fed. So it's not like your core CPI, which just strips out food and energy, but it strips out other also more volatile inputs into the inflation basket, and that's still rising. So that's currently sitting at around 6.5%. Now, naturally, as you lap higher basis, this will come down, but the question is really where this ends up settling. Then a couple of other reasons why we think it would be higher. We've got tight commodity markets. I think this is quite well documented. There's very little supply that's coming into the market across a number of commodities. You have China that's reopening. Yes, that's positive for SA. But that's also inflationary. And then there's also been significant underinvestment in assets such as oil, refineries, and then mines commodities that I mentioned. There's a big theme also going on, deep globalization that started with COVID. A lot of businesses globally realize you can't be overly dependent on China, so guys are moving their supply chains around. But more recently, you also have this big West versus East, and guys are also moving their supply chains around because of that. And that's inflationary. I don't know how that's going to end up in a few years' time, because you might end up with a scenario where China sits with excess capacity, which could be deflationary. But if you think short, medium term, that's more likely going to be inflationary. And then I've already mentioned that base effects will occur. Now, the tricky one that the Fed faces is the US unemployment rate. That's very low, sitting at 3.5%. And the Fed has a target, well, it's not specifically a target, but it's a forecast that they put into their models when they determine the Fed funds rate. And they think that unemployment rate should get to 4.6%. So they're actively telling you that they're trying to slow the market or the economy down and to increase unemployment in the US. So what they're doing, we all know everyone's busy raising rates at the moment, but this is just a picture to show you that the Fed is busy increasing rates at the fastest pace and the biggest increment that they've done in recent history. So if you look back at that previous slide with how inflation's running up, that would seem quite obvious that they'd be doing that. What's, I think, quite important from this, if you think from a South African context, if you've got your mortgage just a hypothetical example, sitting at 10%, if that increases by 2% to 12%, it's not really a problem. Well, it increases by 20%, but if you're sitting in the US and mortgage increases from 2 to 4%, you're doubling your cost of borrowing. So the counter argument to that is that in the US, guys are mostly sitting with fixed mortgages, and also debt is not sitting at a company level, it's sitting more at a federal level versus history. So I think what this could potentially mean is that the Fed actually has to raise rates more in order to bring things back versus what they have historically done. And then just maybe the last point, the market's busy pricing in another 25 basis point increases. So that's the dark black line, we should have that over 5%. I think Citi came out this morning saying now they expect another or third increase, counter to what the market's busy expecting. So here's just different scenarios in terms of inflation. It's quite academic, so here's 4 scenarios. So if you have a low inflation world at 1%, then the multiple on the S&P 500 should, in theory, increase by 20%. So there's 20% upside in the S&P 500. So if inflation is a complete myth and we get to a kind of a Goldilocks scenario, you probably want to go out and buy every tech share you can get your hands on. In terms of the Fed target, the 2%, in that scenario, there's probably around 5% downside to the S&P. If we get to what the 5-year break-even is telling us, the 2.5% is a 13% downside. And then if inflation is more sticky, maybe if we end up at a 4%, then there's probably 30% downside to the multiple of the US market. So there's obviously dividends and growth, which form part of that I'm ignoring in this example. So, what different things perform during inflationary environments? A lot of guys always say this, but they don't necessarily show it. So the gold or yellow line is the CRB metals index, and we're just comparing that to the black line CPI. And over time, that's outperformed. Oil, more specifically, outperforms. The reason for that, one of the reasons for that is oil's a bigger component within the CPI basket, but there's also a bit of a story to oil at the moment that I'll discuss now. And then even better than commodities or actual commodities and oil are equities. That's the third kind of bar over there, US equities. And this is the percentage of rolling 12-month period where different asset classes outperformed CPI. 1973 to 2020. It's a study that Schroders has done. Now that should seem obvious, but I would say it's probably specifically to companies that have the ability to pass on pricing to consumers. And then the other point is it's very important what your starting point is. So you need to think of it in that context as well. Okay, so a little bit on oil. This is really like a demand supply story. You've got the picture there, which is essentially global demand of oil. We're sitting at around 100 million barrels per day. So this data starts in 1996 and then it goes to November 2024. So there's a bit of a forecast in there. It's not our forecast, it's from the IEA. But you'll notice that demand typically follows quite a solid trend line. So you had the 2008 period where demand pulled back a bit, but then it quickly caught up to that trend line again. So we think on the demand side, what could potentially be driving this going forward is China specifically. There's about 1.8 million barrels demand that can come back to the market. Now, if you're observant, you'll notice China's already fully reopened, things are already moving around, but the Chinese bought a lot of oil inventory in anticipation of reopening ahead of this. And then global aviation, that still needs to pick up. There's about 1.2 million barrels there. The counter is the EV market. That's about 600,000 barrels of demand that could potentially come out of the market, kind of short, medium term. On the supply side, it's quite constrained, and I guess that's probably where a bigger part of the thesis is if you're taking a medium-term view. A lot of the global energy companies are under a significant amount of ESG pressure. You can see it in all of their capital allocation. Instead of investing in new projects or exploring for new assets, they're returning that money to shareholders via buybacks and dividends. OPEC has nameplate capacity. That's quite theoretical. There's a difference to what they can actually supply to the market and what the nameplate says. And part of that reason is regions like Kazakhstan, Nigeria, Angola that actually struggle to get oil out of the ground. And then we've had short-term supply increases from the US. I know one of the other speakers also mentioned it, strategic reserves, but inventories in the US are sitting very low. And the US has come out and said at around $70 WTI, they'd step back into the market, rebuilding those reserves. But at some point, they'll need to rebuild them. And then I guess oil demand is quite inelastic on the downturn. I guess the big question is, do you go into a recession before oil price increases, or is an increase in the oil price the cause of a recession? So we're not betting the farm on this. We've got around a 7.5% position. It's not all through Sasol, it's mainly through offshore companies, Repsol and Shell. And it's also not a linear bet. We just think it, within a portfolio context, we think it makes quite a lot of sense at the moment. There's good risk reward. Then just in terms of our current positioning for the year ahead, so the kind of green shaded area, so if you focus on that, there's like a red line there. Whenever that green shaded area is below that red line, that's when we're underweight equities. So, overweight equities. So you'll see the period just post-COVID, we went overweight equity content, and then we started trimming back around March last year, and we're still running underweight. So in the flexible fund, we're about 9% underweight equities. And we've got a couple macro drivers that guide us in terms of this asset allocation, but I'd say the big one is really interest rates and where inflation ends up. So we're quite cautiously positioned at the moment. And then here's just the flexible fund. So I'll draw your attention to that 1 year performance. So we underperformed by 5% last year. It was quite a disappointing year for us. We've gone through like a couple of iterations of what went wrong. And I'm quite happy to discuss that with anyone if you want to afterwards. Year to date, it is going quite a bit better. But the long-term track record, over 3 years, we're still outperforming. So we're still quite confident, that our process works. And then just in conclusion, so 2022, it was a difficult year for performance. Despite the performance, we gained quite a bit of inflow. So we had peak AUMs at the moment. I think it's just over 7 billion. So we're still a small boutique manager, able to move around. Over the 3 year period, we still have outperformed. We're quite defensively positioned. We've increased focus on the fixed income side quite a bit. We were finding we had quite a bit of a drag from the cash that we were carrying. So we're trying to enhance yield there. And then we'll continue investing in quality businesses, favorable payoffs. I've mentioned the oil thesis to you. And then we expect volatility to continue, but opportunities to prevent themselves. We're a little bit more positive on the SA side. It's really on the US market that we're quite negative, despite the recent bounce in the market. And that's our story. Thank you.
Good afternoon. Afternoon, everyone. My name is Chantal Baptiste. I'm an equity portfolio manager at Fairtree Asset Management, and I stand between you and lunch. So I think we can all just stand up. I know you don't feel like it, but just stand up for 2 seconds, stretch your legs. I saw lots of people dozing, playing games, on their WhatsApp, on their Insta. Just stand up quick, stretch your... Okay. Okay, there we go. So because you've done that for me, I'm going to make this very punchy and very short. You have so much information in your head, and all of my previous peers, I'm sure, have enlightened you. I had a big piece on macro, but Nick did such a good job, and I completely agree with him from an inflation perspective. So I'm going to skip the whole macro section. I just wanted to remind you, though, our long-standing relationship with BCI. So from an equity perspective, I'm speaking about equity today also. The equity building block forms part of those products. So it's the Select BCI Equity Fund, the Select BCI Blended Equity Strategy Fund, the Select BCI Balance Fund, as well as the Select BCI Cautious Fund. This is the Fairtree Equity Fund. So this is our flagship fund, the one that's in the public domain, our unit trust. And I'm trying to show you the alpha we've been very fortunate enough to generate through time. That's the orange bars. The blue is the benchmark. We benchmark against the capped SWIX. Last year, we had a stellar year, 11% ahead of the benchmark. And we saw a lot of opportunities. We were incredibly active last year. I'm an equity manager. My job is to look for opportunities. I'm not a fixed income manager. I'm not there to protect. I'm there to seek alpha and make sure I make your capital work as hard as possible. This year started off with a bit of a bang. Markets are correcting a little bit now, so expect another year of a lot of volatility. Within that, though, we are seeing a lot of opportunities. This is what worked and what didn't work during the course of last year. On the left-hand side in absolute terms. On the right-hand side, I like to think in relative terms. So that first stacked bar there and the second stacked bar, that is what you're paying an active equity manager to do. To choose the stocks that are going to go up and then to avoid the landmines. You can see what really worked well for us. Tech, resources, as well as a little bit of Richmond. We missed a few of the stocks that pulled back. Third bar there, that's our overweights that went down. That's when our investment case worked against us, and we spend the most amount of time trying to understand, did we get this wrong? Is this our fault? Is the investment thesis still going to come through, and when will it come through? My clients want alpha today, tomorrow, this week, this month. I don't have the luxury of saying, wait 5 years and then I'll give you alpha. I need to demonstrate it and perform now. So we spend a lot of time trying to understand, is this a value trap? Should we get out of this position, or will the investment case still come through? And then the last one there, those would be opportunities we missed. We did have FirstRand and Standard Bank in the portfolio, but we preferred Absa and Capitec. So we had an overweight, and remember, we would have traded in and out of those positions during the course of the year. From a market outlook perspective, the world has fundamentally changed, and this is what we're trying to explain to our clients. We're operating in a different world. You go through these big themes, and what's happened now is there's two key relationships in the world, or marriages, that have now ended in divorce. The first marriage is the marriage between Russia and the Eurozone, where for a long period of time, Russia made cheap energy. They gave it to the Eurozone, and the Eurozone produced nice luxury vehicles, which we bought, and they made a big premium. The second relationship that is fundamentally broken down, or marriage, is the one between China and the rest of the world. We started to dislike China through COVID, and slowly it just became less and less liked, less and less loved, and then it became completely uninvestable during the course of last year when the market capitulated during October after their Congress. So those relationships have broken down. And remember, for a long period of time, what China's been is the factory of the world. They make everything, all the cuck that we buy that only lasts one day, at a very low cost, and then all the retailers sell it on and they make a big profit. That relationship has broken down. China said we are not going to be the factory of the world. We now want to be the tech superhouse of the world. This is all very inflationary in nature, and that's where I completely agree with what Nick was saying. We are going to remain in a structurally higher inflationary environment for a period of time. Yes, it will come down. One of the previous speakers also mentioned that. It's mathematics. It has to because of base effect. But oil, energy is going to remain expensive for long. Why is that? Because for the last decade and a bit, we've demonized fossil fuel. It's evil, we can't invest in it. But at the same time, we haven't transitioned into green energy fast enough. And then you have a little bit of a crisis, a little bit of a supply shock because of the Russia-Ukraine war, and suddenly we realize the world doesn't have enough energy. And it's not just South Africa. We do have our own problems, but it's not just South Africa, it's the whole world. And energy that we are investing in now is going to be, by unit, far more expensive than fossil fuels. That is inflationary in nature. We have a backdrop of geopolitical risk. We have a war going on at the moment. All your big economies are investing in defense, inflationary in nature. And then what's really interesting is this whole ESG decarbonization rhetoric, and that is providing a secular support for your base metals and your industrial metals. So that's the world in a nutshell. Lots and lots of volatility, lots and lots of risk, lots and lots of moving parts, but a hell of a lot of opportunity for us. And that's what we're seeking day in and day out. This is something I wanted to touch on, and it's just out of interest more than anything. I wanted to show you, and I took it back to 2001, so that would have been 2 decades ago. We, as a globe, we're getting about 86% of all of our energy from fossil fuel. We've had a lot of talk, a lot of targets, a lot of your big economies coming together, a lot of pledges. We had Greta, and now today, we're still getting 83% of our energy from fossil fuel. All that renewables has done is actually replaced a lot of nuclear. And we're not allowed to talk about nuclear, by the way. So we've got to talk about that green part there. Now, the optimist in the room will say, but Chantal, you can see that it's grown. Yes, I agree, but it hasn't completely replaced it. We haven't tipped the scales yet. There's a lot of work that needs to go into renewables, into alternative energy. That is happening in the background. So these are the slides I'm going to skip because Nick did such a fantastic job of explaining inflation. And I'm going to move on to China, which I always find quite interesting. Now we're going into a potential US slowdown. Some people are calling it a US recession. The indicators don't look slow. The indicators look strong. The US looks hot, it looks robust. But even if we do go into that environment, I wanted to point out how important China is from a commodity consumption perspective. I've used iron ore on the left-hand side as a bulk metal proxy, and I've used copper on the right-hand side as a base metal proxy. Look how much of these metals China uses. China's important, and what's happening is China is reopening. I'm not saying they're going to go out there and build lots of roads and bridges and that. So I'm not a huge iron ore bull. I think iron ore will remain very resilient and supportive. But they are unleashing 1.5 billion human beings who have been locked down. Do you remember what you did when you came out of hard lockdown? Not all of you are as young as I am, but the first thing I did was I wanted to see my friends. I wanted to care. I wanted to party. Suddenly, 40ths were back on the go. Weddings were back on the go. What did you spend your money on first? You spent it on stuff. You spent it on entertainment. And that's exactly what is going to do well in the first leg of the China reopen. You want to have exposure to alcohol, tobacco, luxury goods, transportations. They're going to travel hand over fist. Then you have the knock-on when they realize they actually want to upgrade their car, so it will favor the PGM plays. And then maybe you start having home completes, a little bit more of an infrastructure drive. But China unlocking is significant. They are huge. China is the second biggest single economy in the world. It sits at 18 trillion US dollars. America's the first, 23 trillion US dollars. So China matters. It's not a small EM market anymore. Out of interest also for the year, and I always find this interesting, we're in the year of the rabbit, and they always assign an element to it, so it's the year of the water rabbit. Now, in Western culture, we think of the rabbit as a very hasty animal. You know the story about the tortoise and the hare, and slow and steady wins the race, but the hare loses because he's too hasty. It's very different in Eastern culture. In Eastern culture, hare is seen as a very cautious and considered animal. It sits back and it thinks. It doesn't do anything rash. And that's what we're expecting during the course of this year from a China perspective. Xi Jinping has secured his position as leader for life, and so he can sit back now and allow the market to reopen. This is a huge bifurcation we would have seen during the course of the last 2 years. The orange line there is the NASDAQ, which is US tech. The black line there is Tencent, which is a proxy for EM tech or China tech. And you can see that historically they've always moved in tandem. So when there was news flow in tech, both these big counters would move together. Then China announced the 3 red lines and a host of other regulations. They decimated their property market. Now that's important to understand because 30% of Chinese GDP is property. It's not like this country or other developed markets, you know, the UK, the US. You don't have a whole bunch of IFAs running around managing people's wealth. Chinese people, by and large, put their money into their homes. So you can imagine the ripple effect when suddenly you start losing the wealth in your homes. What also happened is a lot of the buildings that were the new homes had been pre-bought. So at me as a Chinese individual, I have a home, I'm busy renting, my home's not complete, so I've taken out a home loan or a mortgage on it, and suddenly the property developer calls me up and says, sorry, I've gone insolvent because of the new regulation. I can give you a home, but there's no roof, there's no windows, and there's no door. What are you going to do? You're not going to move in. You're going to stay in your rental and you're going to default. So that was that massive contagion effect that happened in China. And they single-handedly decimated one of their key growth vectors. I don't believe Chinese GDP for last year. I don't think it was 3%. I think it was deeply negative, but they produced what they want to produce. They really, really hurt the economy during the course of last year. Then what happened is the Ukraine-Russia war broke out. And what we did is we said, Russia is uninvestable. Overnight, if you had exposure to it, that went to zero. What happens in your world when something like Steinhoff happens? Your clients phone you up and they say, what's the next one? Is it PSG? Is it Capitec? Is it Brait? What other Afrikaans type company is going to go bust now? And you say, don't worry, it's an isolated event. It's okay. There's not going to be contagion effects. I live in Stellenbosch. I'm allowed to say stuff like that, okay? That's exactly what happened. All your big general gem fund managers, they said the next basket case is China. It's uninvestable, and you saw them withdraw. And then you saw during the CCP Congress during November last year, right at the end, on the 5th day, they always allow the media to come in. And what happened then? The media came in, and Hu Jintao, who is the previous president of China, got forcefully removed. And that was a middle finger, and that was a warning to everyone to say, I'm Xi Jinping, I'm the most powerful man in the world right now, and I'm leader for life. He had to solidify his power. What happened then? The market capitulated. We bought into that weakness. We bought a lot of commodities, we bought a lot of NASPAS, and we bought a lot of process, and the market was going in the opposite direction. Why is that? Because there's a huge difference between politics of a country and policy of a country, even our own country. What the politicians say and what they pander about is very different to our underlying policies. And we read the policy document. Xi Jinping wants to grow the economy. He wants to double their GDP over the next 13 years. How does he do that? He has to grow it by about 5% every year in real terms. He can't do that. The government can't grow their own economy. What do they need? They need the private sector to step in. So our thinking was, he's not going to go out and kill their capital markets. He's actually going to be quite amicable. We didn't expect them to unlock towards the end of last year, but they did. And NASPAS and Process, as well as the commodity sectors, were huge, huge key contributors to our performance. I'm going to quickly move on to SA, and I know we've spoken about it a lot, but just maybe one or two things to mention, and I don't even need to show you this slide. It's normally for my foreigners. You were in the dark a third of last year. That's the reality. And this year is going to be even worse. That's the reality. Okay, we've just cut 7,000 megawatts, 7 gigs. So now we're in stage 7 load shedding. It's going to get a lot worse before it gets better. So brace yourself for the course of this year, okay? The load shedding will be very, very, very bad. Worse than last year. That's the reality. Okay, so that's the bad news. And unfortunately, what's happened is, I don't have it in the slide pack, sorry, but our confidence has been absolutely decimated. So we're in a confidence crisis. We've been in a confidence crisis for some time. 2015, Nenegate was probably the turning point, and since then, it's just been downhill. Foreigners don't want to invest. The sad thing right now is we're decimating our manufacturing capabilities because they don't have power. And I'm not talking about your big industrial listed companies. I'm talking about the SMEs, the smaller guys. And those are the guys that create jobs. So we're losing jobs. People are immigrating. We're losing tax base. It's very, very negative. The positive is that we have made these announcements. And I know there's huge implementation risk, but the nice thing is that the government hasn't stood up and said, we're going to fix this. What they've said is, we're going to, as they always do, pull together a committee, NECOM, which does very little. They just show presentations, but nonetheless, they've identified the problems. So at least we all know the problems. There's a lot of investment going into this space from a corporate perspective, from a private sector perspective. So again, the private sector is leaning in, and we will solve for this. What we do need to do, though, is become a little bit more practical. When you replace base load with renewables, it's not like for like, okay? There's about a 6-factor difference from a capacity factor perspective. I'm not going to get technical, but it is not like for like. Sun doesn't shine and wind doesn't blow 24 hours a day at the same intensity. It's different to coal-fired power stations. And I know you don't want to hear this, but we actually need to fix our coal-fired power stations just to reprieve us, to get us to about a stage 2. Then we can bring all the renewables on stream and push out the grid and get everyone feeding it back. And hopefully this afternoon we do get tax incentives. But the neat thing is that I would never, ever bet against the animal spirit of humankind, let alone that of a South African. We are incredibly resilient. I actually said this morning, I'm tired of being resilient. I don't feel like it anymore. I feel like we dealt with COVID. We've dealt with so much. I don't need to be any more resilient. But we are very, very resilient. We find a way around things. And what's happening in the background now is a lot of innovation. And you've seen it happen before. The last time as a human race we really had proper large-scale innovation was the World Wars, World War I and World War II. We've kind of sat on our laurels since then because we've had a lot of global peace, we've had globalization, we've had free trade. That's reversing now, and globally we need to make a plan. This is when you're going to get the smart minds coming forward and coming up with ideas and investment opportunities. The renewable space is another investment opportunity that will exist in the future. We are going to solve for it, but this year will be painful, and that informs our underweight positioning on SA Inc., your hospitals, your retailers, your property groups, your banks, your insurance companies. They're going to take it on the chin during the course of this year, and ultimately as a shareholder, you take it on the chin. So they will come under pressure this year, but we have very, very good corporates. They'll find a way around it. We're just seeing better opportunities from a global perspective. Just to remind you, this fund is 11 years old, and since inception, it has been 100% invested on the JSE. We do have our Reg 28 allowance, but we haven't used it because we've always seen opportunity sets within the JSE listed space. And I showed you the performance at the outset. So what we are stressing to our clients during the course of this year, defense. We have globally higher interest rates, globally higher inflation for some time, so we want to try protect for that. We have a bit of gold in the fund. We like alcohol, we like tobacco. The Chinese market is going to reopen and consume that. We like luxury. We like diversification. In each one of those buckets, we're not betting on one horse. In the PGM space, for example, we have exposure to all four. We have a preference for one or two of them, but we have exposure to all four. And lastly, liquidity. Those top 20 positioning, it's all liquid names, and we want to be able to move in and out of positions. Last year, we traded very well. We did very, very well in Naspers process, the commodities. Richmond was a key attributor to our performance. We only went into that stock in the second half of last year. So we want to be able to do that for our clients' money again this year. We're not day traders, but we are alpha generators. And to be able to do that, you need to seek the opportunity. So within all of this mess, within load shedding, within all the risk, we're going to get really, really neat opportunities during the course of this year. And I think you can have lunch now.
Well, a strong finish there. Thank you so much, Chantel and Nick. We really appreciate it. Just a short note, the Select BCI Cautious Fund, the name is going to change to the Fairtree BCI Select Cautious Fund. So we're adding your credentials to that fund. Thank you so much. To our presenters today, thank you all for doing a tremendous job and all the preparation and the work that you've done for this event. We really appreciate it. And to our audience, thank you for coming through here today. Absolutely lovely venue. So Olga, thank you for arranging the venue. We really appreciate your continued support. And BCI is now the 5th largest manco in South Africa. So well done to all of you. The presentations and the recordings will be uploaded on the BCI website under the Boutiques on Wednesdays tab or link, so you can go and have a look there. If you're not sure where to get hold of it, please speak to your BCI team member. To the multimedia team, thank you for setting everything up and taking us through load shedding. To the marketing team, thank you so much.